In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
That was a quiet day. It's Tuesday, April 15th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York. We have Dylan Radigan in Milan, and today in studio, Michael Butler. Mike, welcome back to the show.
Appreciate it. Thanks for having me on. Hello, hello. I'm just realizing my background is kind of a blend of yours, both of you.
That's good.
It's kind of fun.
Like a primary color wheel.
Yeah.
You look like Jay Powell's tie in the background there, who we're going to hear from tomorrow, of course. Maybe the market's waiting on him. If you're joining us on the platform, if you're coming to us on the website, tastylive.com, join us in the chat. Come over to YouTube. Tell us what you're trading. Did you have a chance to take a breather? This week's been relatively calm so far. S&P 500 down by 0.17%. NASDAQ up by 0.16. Russell up by 0.14. The Dow Jones down by 0.4. It's a quiet day. Bonds are up a little bit. We see the dollar fighting back some. Maybe the end of Pax Americana isn't here after all. We make our way through this market, and quite frankly, I think all of us are a little shocked about how quiet it's been. Volatility's mean reverting, of course, but today, as I was expecting you, Mike, kind of like waiting for something to drop, and nothing dropped. So as our returning guest champion here, Mike, you kick things off. What do you think of this lack of action on tax day?
Maybe it's that. Maybe it's everyone partying with their accountants. I actually got a text that there's an accountant I know that's having an end of tax year party. So maybe it's that. I totally forgot that it was tax day. Maybe everyone's out at McDonald's getting their 50-cent hamburgers or whatever they do on tax day.
Wait, what?
I feel like they did that a couple of years ago. McDonald's did like a tax day 50-cent hamburger deal, but that's neither here nor there. I feel like
I haven't hit my protein for the day, so maybe it's not, maybe it is here soon. There you go.
Synthetic protein on deck. Yeah, I think a 2-day cooler is to be. It's a little surprising to see the range just drop off a cliff. We've seen 150, 200 point ranges every day, and now we get these two back-to-back 50-point days ish. But yeah, Jay Powell speaks tomorrow at 12:30. I don't know if maybe the market's waiting for that. I like to look at the expected move in SPX or the E-mini futures. You've got a 60-point expected move through tomorrow and a 90-point expected move through Thursday, which is the last trading day of the week. So pretty front-loaded in terms of implied volatility. 60 points tomorrow, only a 30-point additional expected move for Friday or Thursday. So maybe it is. Maybe we're in wait-and-see mode until tomorrow, 12:30.
Dylan, before you were mentioning how the dollar's looking good on a reversal here today, it climbs a little bit.
Well, I'm just thinking reversal of fortune on a bunch of these things, whether it's oil, the dollar for sure. You kind of just get a sense even Trump might be exhausted at the moment just from all this excitement of the last few weeks. We need to take a break.
I don't know, man. He has like an unlimited well of energy. That's the one thing. I want whatever. I'll have what he's having.
Yeah.
Dylan, so you're looking for a reversal of fortunes. What makes you feel that way? Because you have been quite critical of Trump, which I think would surprise the chat for hear me to say. No, I don't think it would. So what makes you think there's a reversal of fortune?
Just a price extreme. I mean, just a lot. It's old school tasty trade price extreme at this point. I mean, whether it's the up move in gold, the down move in oil, the down move in the dollar. So it's not to say that some of the underlying critique that I may have offered, I have not changed my point of view in that, but my goodness, you've got some price extremes going up and down, and then the pause. I mean, it's a little predictable, I suppose, but you have these big extremes, and then you basically just have a complete contraction in the range at either highs or lows. I mean, it's not that much more complicated than than that. But it's hard to see how some dollar strength is not in the cards here. Some sort of an oil rebound is in the cards here, and some sort of a gold pullback. I mean, only on price extreme, and to Sosdov makes this point all the time. Markets tend to overexert or overextend themselves, going up and down, and we certainly have had some extreme currency movements down in the dollar's case.
Mhm.
And we've had some extreme movements in gold up. So why, it just seems like a reasonable place to at least take a closer look at what's available in terms of a trading position, without getting so tied up in the more existential aspects of running a government this way, or the recession or growth or CEO uncertainty and all those other things, and just go to the pure trader mentality of this thing's moved a real big distance in a real short amount of time and then stopped like a hard stop. Seems within reason that it might recover some of that the price extremity might reverse itself a little bit, whether it's a weaker euro or a stronger oil price, for instance.
Mike, I don't think it's too difficult to suggest that we're sitting at price extremes right now. How do you find your perpetual buy the dipness being impacted throughout all this? Do you find yourself leaning away from that, which has served people like you and me very well over the last few years? Or are you still running full bore into that? There's a sell-off, the market's going to rebound. Let's find opportunities to get long.
It's a great question. I think it depends on your strategy. So
right,
if you're doing, 45-day trades and you're trying to play directional moves in a market like this, I think, and we talked about this at length a few sessions ago on Options Trading Concepts Live, but I think you have to remove yourself from I'm placing this 45-day trade and I'm taking it off or managing it at 21 days. And you have to be in the mindset of, I'm placing this trade today. If I get 20% tomorrow, I'm taking it off. Like, you have to be much more nimble in these markets that are moving around. But if you're talking about equity positions, like buying shares of stock, a couple days ago, you could buy literally any stock that you thought of in the tech sector for 20, 30% off. I really like SVXY here. SVXY is a way to play for a volatility contraction in the long term in a defined risk, or at least in a buying shares way, as opposed to shorting the VIX or volatility futures. You can buy SVXY, and SVXY is a 0.5% daily percentage move tracker of the VIX. So when volatility is in contango, a product like SVXY will drift higher over time. And that's especially true if you see the volatility futures go from the high 20s to the high teens, the mid-teens, the low teens, et cetera. So I like SVXY a lot for just like a long-term, I'm banking on volatility contraction event eventually. But yeah, you've got a lot of tech stocks beaten up. TSM has earnings on Thursday morning. This is one of the first semis that is going to announce. I just wrote an earnings preview on it today. It'll probably be on the News and Insights tab on tastylive later this afternoon or tomorrow. But this one's interesting. I mean, I was looking at just the underneath the hood. They get 80% of their revenue from North America. From January, February, and March, they've increased year over year 40% month over month revenue figures. And this stock is near the lows. So it's like, I think a lot of these stocks are reacting in fear of tariff news. And it's just a matter of like, will this come to fruition? And if it does, what does that look like?
Yeah, it feels like this is a really interesting earnings season.
Yeah.
Dylan, we talked about how there's no guidance capacity for any of these companies.
Yeah.
But do you think that clouds the picture? Because you just talked about all these like glittering fundamentals that should draw any value investor's eye, right? Or even growth investor. Hell, those are really impressive figures. Yet, how could we possibly say that these earnings are going to be any guide for the future? Is that a complicating factor for you, Mike?
Definitely. I think at the very least it will increase the weekly implied volatility where their earnings announcement lands. But in a lot of these stocks, like TSM is an interesting one where TSM, they have earnings this week, but the expected move is only like 5-6% of the stock price. And then if you look further to June, July, there's still plenty of implied volatility readings in those cycles. And same with your Apples, your Microsoft, your Netflix. So I think at the very least, you're going to be able to reduce cost basis much more aggressively if you're selling premium in the earnings cycle.
Today was a day where we had a lot of banks out. We also had Johnson & Johnson, Ericsson among the top performers or top names. Tomorrow, ASML, which of course is your buddy Nick's favorite. He's been talking up that a lot here in recent weeks and months. And quite frankly, that's a company that's probably going to be in the spotlight if we're going to reshore a whole bunch of, of the supply chain here. Netflix might be the biggest one that's not related to tech in the coming days here. Mike, Dylan, before we get back to you, do you have any plans for Netflix earnings this week? You being more of a earnings trader than I am.
I'm probably going to play it. I like calendar spreads in here. It's such a high price stock. It's really hard to trade in an undefined risk way, or even with like a diagonal spread. But calendar spreads I like in here. I heard that Netflix is projected to or has already met with Dana White from UFC because the UFC contract ended with ESPN. And Netflix has already kind of dabbled in the live sports scene with that big boxing event last year. They took some NFL games. I think they had 2 Christmas games for the NFL. So, if Netflix all of a sudden becomes one of the leaders in live sports entertainment, I think that's huge. So we'll see. But yeah, I think from an earnings perspective, like again, you're looking at a $900 stock with a 92-point expected move for the next 10 days. In a 60-point move for Thursday. This is a weird one though, because they announce earnings after the close and then you can't trade it on Friday, because the market will be closed. That's
kind of what I was rounding into, because some of these earnings releases that you have on Thursday, they would be very interesting to perhaps approach from the earnings trader perspective. But for the fact that if you put something on Thursday, you're not going to be able to touch it until Monday morning now because of the market holiday this Friday, which kind of glad you reminded me of. I don't want to admit I forgot that we didn't have work Friday. I would have showed up and wondered where everyone was. But hey, we talk about the sector. Go ahead, Dylan.
No, I mean, I'm just interested. I'm actually honestly interested to hear Mike talk in a little bit more detail just about, something like Netflix just feels like it's a classic example of, the size of the opportunity is significant, but by definition, a big opportunity is just fraught with risk. And, it felt like that, at least in listening to your comment there, Mike, and reading between the lines, that you felt that there was some way to approach this that at least nibbles on a piece of the opportunity without being at such a great risk of just being paved over, when you're wrong.
Yeah. I mean, any $1,000 stock, it's hard to play the game when you have, like, it's crazy. You look at June and you've got $6,000 option prices. Like, it's hard to get small in there.
It is difficult to get small in there. Define risk. You mentioned the calendar spread as a way to go about playing this. It seems to make sense. An interesting, perhaps, tariff-related headline. United announcing plans to cut flights as domestic U.S. demand slips. There have been signs, again, we talked about this in the CPI report last week, how when you read through the line items there, the biggest areas of decline in price pressures, hotels, rental cars, airfares, signals a slowdown in both business and consumer travel. And this is a service-based economy. So if we're going to slow down the service sector as a knock-on from our tariff adventures, then you probably think more about recession, which is, I think, one of the more interesting aspects to look at this market through the lens of how the sectors performed today. The banks did well. I mean, listen, you've had a good run of bank earnings here, and that's not hurting anyone. On one hand, SMH is the best non-bank or non-gold related ETF on the session, up by 0.65%. On the other hand, retail was slugged. Retail has been our North Star for this whole process. XRT is down by another 1.57%. It was the first one to fall after the Fed in December. It never recovered back to the highs. It led on the way down. It reacted the most negatively when the tariffs came into play. It is, of course, the sector that tends to show the most sensitivity to recessions. So, Dill, I mean, what's the recession call here? Today was a calm day. Yesterday was a calm day. Have all of our problems been solved, or is this merely just a pit stop?
I mean, these sort of, I think everybody is aware of the one underlying dynamic, which is that the market, in a shocking, I mean, not just the market, the news cycle, the market, all of it, there's a shocking absence of memory. It's like the I don't know, I'll date myself, but it's like the Men in Black, like the pens, where it's like whatever happens, whatever, and so I think that there's an aspect of the no memory vibes is at work, but it's if I just to channel my inner Ilya Spivak, there's no way that the recession is not cooking. I mean, may not be guaranteed, but the probability of slowing economic activity by pure mathematics of higher costs to the higher transactional friction to perpetrate any transaction, by definition, increases the probability of a slowing economy. And so, of course, no. You can't rule out the recession odds haven't changed, meaning recession odds were there pre-tariff. Like once you initiate a tariff campaign, even a perfectly executed one, which obviously this was not, but a perfectly executed one, by definition, is in the short term going to raise the cost of everything and increase the probability of an economic slowdown. A wildly and sort of chaotically implemented tariff regime raises the cost of everything more and increases the probability of an economic slowdown more. And so, it's ridiculous to suggest that that the market's behavior the last couple of days is a reflection of anything other than absence of a reason to do anything other than catch its breath. Now, what's the recession trade is another question, I suppose. I mean, I wonder whether it's sort of my concept or my thesis of price extremes, whether it's in the dollar or oil or gold. Maybe, I mean, look at that move in Philip Morris or Lilly. I mean, you could, the point is there's a very good case for the market being overextended. Wonder at the parameters of extremity would be another way to say it, whether they are up or down. And even if Philip Morris comes in a little bit, Lilly comes in a little bit, whatever it is, doesn't mean the odds of recession have gone away. It just means that valuations in publicly traded securities get out of whack, which is a well-known fact, which is also where opportunity can start to come into play. And so, I'm more interested in a long dollar position or a long oil position than I would be a short Walmart or a short Philip Morris. And just because I was even sort of from a sentiment perspective negative on Philip Morris or Walmart is not an indication of the fact that I believe that the probability of any slowing economic activity is that the probability of slowing economic activity has changed at all just because the market has calmed down.
Mike, how are you proceeding from here? I find this to be an incredibly frustrating environment. I'm spending far too much of my time outside of the typical working hours, paying attention to social media, paying attention to the trading platform, looking for news. How does one adjust to that? Tell me how I can back away from the abyss. And I'm sure other people feel the way that I do.
Well, I kind of see it as a sort of like a sliding scale, if you will. So when the VIX is low, we have to find and manufacture high implied volatility opportunities, which means for me, trading a lot more equities and trading. If I'm doing undefined risk strategies, maybe it's in like IBIT. I like IBIT a lot because it's a $50 stock with 60% IV. You can do anything you want in there. When the VIX spikes like this, I tend to move away from equities and I move into the ETF world. So the SPYs, the SPX, the QQQs, just because now you don't have to manufacture the high IV products or strategies because they exist in these ETFs, and these ETFs have historically low implied volatility, and now all of a sudden you get an opportunity to place a trade that gives you a similar premium as Apple did or Microsoft did a few days ago. So I like kind of shifting towards the broad-based products when the VIX is spiking. So I have a lot more positions on in SPX. I have 2 separate iron condors on. I had a short put spread on that I took off today, and that was largely just due to the volatility crush we saw versus a rally, because I placed that like 2 days ago. And yeah, I think for me, it's moving out of the equity world and capturing the equity movements or volatility collapses within that ETF space, and then taking shots in micro futures products. So like to Dylan's point, I have a long micro crude contract. It's a $6,000 product. I can hold it forever. I'm looking for a bounce here. Micro crude and crude in general has been a great trading vehicle for the last, as long as I can remember, 3-5 years. It's had 2-sided action every single year. So I kind of like to take shots at that when we get to these price extremes. And then speaking to gold, I have similar positions on. I have a butterfly in gold futures that I legged into from a Brookwing butterfly. And I have a downside GDX diagonal spread. So like, this is a great example. Like GDX, 60% IV, huge implied volatility increase, but it's still not even cracking 40% in June and beyond. So you still have a sub 40% IV structure where you can get into a diagonal spread. Like I have a 5-point wide diagonal spread that I paid $2 and change for. So you can get really small in these products, even though they have implied volatility increases, and you can reduce cost basis effectively as long as you're selling some kind of near-term premium against it. So that's kind of where I stand. But yeah, staying small, keeping risk in check, and just being a lot more nimble with positions and movements in the markets. I don't think I've taken 50% profit in the last month, like at all. It's been just like, I placed this trade.
Okay.
Yeah, it's like I placed this trade. The next day, it's moved to my favor. I take it off for 20%. So like those are the kinds of situations I'm getting into more. Aside from like the wide iron condors that I just let sit, and those I'll just let decay because it covers such a wide range. But then again, in SPX, I thought I had a wide range, and then I was 300 points in the money. So still got to keep your risk in check.
Yeah, I mean, risk. You can only control what you can control.
Yeah.
Position sizing, timing out of the market, right? You get too big in these. If you're trading ES and you're finding yourself getting chopped up, maybe go to MES, right? ES is 10 times the size of MES, so do 5 MES contracts instead of 1 ES contract if you're just trading the futures outright. You have to stay within your limits here. As for me, I find that I'm just kind of sitting in what's been working. Gold continues to work. When Tom said this morning on Let Me Explain that he's looking at gold and sees like this is a very obvious short to him, I look at gold and say like, oh, this looks pretty clearly like a still obvious long, just from a pure momentum perspective, of course. But there is a dynamic here that really underscores everything that's happening right now. In a world with stocks and bonds bouncing back and the dollar staging a significant rally, why on earth would people want to hold a rock that produces no cash flows, right? I understand that as someone who's been very optimistic around gold. It says something about perhaps even myself that I'd rather play long gold, a rock, than invest in the earnings potential of the NASDAQ right now. So I think if you have something that's working for you, if there's something that you did this week, if there's something you did last week and it continues to work, you got to stick with it. I mean, Mike, I think your point there of you have trades that you put on, and if you're seeing it come into profit very quickly because of how fast the markets are moving, you're willing to take the chips off the table, count your winnings, and then find the next trade immediately and not get married to anything. We're speed dating here. Well,
Yeah.
I'm not with gold. Gold, I'm going into the ground with. But everything else, we're speed dating here. I look at the technicals here, and I still don't see signs of the recovery yet. It's a really messy chart. Not only do we have earnings being revised lower and growth expectations being revised lower, but this is a market where you still find all this negative technical momentum. We have our moving averages in the short term. Sure, we're back above the 5, but the 21 still has a negative slope. The 100 now has a negative slope. The 200-day now has a negative slope. Momentum spilled over here. We haven't cleared out 5,500 either, which is now the 1 month moving average on the nose, and it lines up oh so neatly with the swing lows that we had there in the middle of March. So get us through 5,500 tomorrow. And ES then probably has a sky of 250 points to it. Otherwise, right now, I guess the risk to reward, as Ilya would put it, you could be short here against 55, right, Mike? And if you're correct, then you're risking 75 ES points, potentially for a swing back down towards the lows. Decent risk to reward.
Yeah,
We're also at the midpoint of the trading range. You could also just put on an short iron condor and go to sleep.
Yeah, I mean, volatility is still elevated for sure. And some of these ranges are kind of crazy. Like the first SPX iron condor I put on, I think I covered like a 500-point range for $3 for a 10-point wide. And then the next one I put on, it was like a 900-point range for the same premium. So, but the premium is giving you the ability to go far out on the strike plane. But yeah, I think, with earnings looming and all this uncertainty, like the fact of the matter is there's still a huge concentration in a lot of these stocks. Like even in the E-minis where you have a lot more flattened distribution, you still have Apple, Microsoft, Nvidia, and Amazon making up about 25%, 20% of the top weightings. And in the NASDAQ, it's even more aggressive. So like if all of these companies just tank, like you're going to see that reaction in the futures for sure.
What's your favorite Mag 7 stock right now, Dylan?
Amazon.
Still Amazon.
I'm always sort of debating between Amazon and Meta. I mean, occasionally, as you know, I get seduced by Apple. But Amazon and Meta to me are the two most interesting of the Mag 7 as an ongoing thing. Amazon, I guess I have to be a little bit more cautious. I shouldn't be so reflexive just because of the tariffs, I think, are more of an Amazon issue, certainly than they are a Meta issue. I love Meta as a second-gen AI play.
Still, yeah.
And I feel like Amazon and Apple are obviously much more vulnerable to tariff madness. But also they're so massive that they're all, and obviously they've already been carved out, that if anybody's going to get an open lane of tariff, waivers, it's Apple and Amazon, which is, part of what maintains some of my confidence in them. But relative, look at Meta, what is that, a month ago? Started to get, clubbed. I don't know from a trading perspective, but to the degree to which you want to have names like this in your investment accounts, now seems like as good a time as any and a better time than most to get some of them.
Long term, yeah. I think Meta and Google as well. Google here has seen its P/E ratio come down quite sharply. It's sitting closer to like 16.5 right now. Pretty low, below its 5-year average, below the 10-year average, and they have a very impressive LLM. Are these anything more than Chat GPT's, rather Studio Ghibli image generation tools? Yet to find out. I suppose we learned that the tariff policy was done through Chat GPT. Andrew Cuomo, former New York governor, running for mayor of the city right now, he admitted that his housing plan was from Chat GPT. So I don't know. Maybe we're just handing over the keys of government to the computers already, Dylan.
Yeah, and I think that now the whole game is you're just like a prompt. You're like, give me the best housing plan for New York City. And it's like, beep, boop, beep, beep, boop, boop, beep, beep. And there it is. You got to use the best plan ever. But, assume you are the world's foremost New York City housing planning expert. ChatGPT is like, at your service, sir. Write up a plan. I mean, The whole thing is borderline preposterous. And I don't even say that I say that in an awestruck-stricken way. The product is obviously imperfect, but it sure turns everybody into an editor, and it sure eliminates drafting. I'll tell you that. And there's a lot of value in the edit, but a lot less. It's in the prompt in the edit now. It's no longer in the draft, which is a shocking transition, I guess, in the way we relate to producing and sharing and exchanging information. It's not even so much like what is your plan, Chris Vecchio, so much as it is what prompt did you use to create this plan, and why is this the plan you advocate for?
Please come up with a housing plan in the voice of Chris Vecchio. Why did you come up with this plan? What do you mean?
Please arrange a non-recourse, easily disposed of billion-dollar line of credit for Chris Vecchio to build housing.
Your lips to God's ears. But
the point, all jokes aside, I mean, this has economic value for someone somewhere. I mean, I guess the obvious people that are right there is OpenAI, and maybe Musk with XAI and Grok. And then I suppose, I mean, the one name I didn't bring up in the context of your Mag 7 question is Microsoft, which still is arguably the best positioned for the whole thing.
You know, and they made their capex cuts announcements a few months ago before this all started with the tariffs. And I can't help but think between that, and I know it's only two stories. I want to connect two dots here, and sure, that makes a straight line, but just walk with me for a moment.
Okay.
We have Microsoft's capex, plans. The spending's being cut coming out through February and early March, well before the tariffs are announced. And since the tariffs have been announced, Microsoft is up. Apple. This story is on CNBC's front page right now. Apple airlifted iPhones worth a record $2 billion from India in March as the Trump tariffs loomed. They were ferrying 600 tons of iPhones to the U.S. in February and March prior to the U.S. increasing its tariff threshold. Makes me wonder if they got a tap on the shoulder from someone and said, hey, these tariffs are coming and they're going to be coming big. You better do something now. But I point that out because both Apple and Microsoft, in hindsight, made the kind of decisions ahead of the curve that perhaps insulates them over this next medium-term cycle from any significant downsizing. They're not going to go through a big, they didn't overstuff their inventory channels, for example, ahead of this. They didn't overbuild. Microsoft already started cutting, and so if they need to make further cuts, you can't really say like, oh, well, this is an abrupt change to them. The tariffs are screwing them. No, they've already made this decision. This is all part of the plan. Calm down, folks. Do you think these stories are good for investor confidence, Dylan? That Apple is airlifting phones out of India to beat tariffs? That we have a great Beijing airlift going on, akin to what we were doing to Berlin?
That's a rhetorical question.
No, it's really not. It's really not. Like, how do you make this? Should the PE multiple be a little bit lower for stocks if we have to airlift?
No, but I think the expectation is ultimately, I think that if there's one place, I mean, there's many places, but if there's one place where there's a tremendous amount of skepticism as to any real aggressive implementation of tariffs, it is in the mega tech space. I think that people just don't, I think that the marginal trader, whatever the sort of collective wisdom of the efficient market is, does not believe that there will be consequential tariffs that will have a meaningful impact on these companies, which is not to say that the other stories are not there, like your airlifting story. But again, that sort of plays to the sensationalism of a social media driven news cycle, because the idea of airlifting phones to clear a tax barrier is so it's catnip from a clickbait standpoint relative to financial news. But I think the market is remarkably confident that if anybody's going to be immunized from the tariff war, it is big tech. It is the heart of the American economy revolves around basically three, you could argue maybe a fourth thing, but big tech, big entertainment, and big finance are the three pillars of the American growth engine. And, it's one thing to play games with reshoring medical device manufacturing or reshoring, I don't know, some auto part of the car manufacturing or the car supply chain. It's a totally different thing to try to think that they're really going to force iPhone manufacturing back to the United States. I just don't think anybody actually thinks that that's going to happen.
No, no one's going to want to pay, $3,500 for an iPhone. So that's just not
And
the
Tim
economics of
Cook
it.
is sort of very famous. The Apple CEO is very famous for saying the reason that they make iPhones where they make them in China is not because it's cheaper to make them in China, but because it is a body of domain expertise that exists in a dense fashion among many, many people who have an expertise in advanced tooling of electronic machine manufacturing, the same way that there is a huge labor pool in Southern California that's related to the production of entertainment content, or there's a huge labor pool in Northern California relative to technology, or in New York relative to finance, or Chicago relative to finance, or Texas relative to oil. Well, there's a huge labor pool in certain parts of China that is specifically skilled at advanced manufacturing tooling, and that doesn't exist anywhere else in the world. And that's why Apple makes iPhones there. It's not the only reason, and it's not the reason that they started there originally, perhaps, but it's the reason that they stay there now.
It's a really good point you make about the labor pool skills, right? Because we just don't have, our labor pool has not been trained in those areas right now. It's like, well, we don't really have that many successful textiles left over. And I don't mean that in a demeaning way. We actually have something that's happening in real time right now that's in the news that you can look up yourself. If you look up LVMH Texas, you'll find stories about an LVMH facility that was opened 6 years ago in Trump's first term to help bolster the reshoring of American supply chains. And LVMH opened up a facility in Texas in order to help please the Trump administration, grease the skids, if you will. This factory now, 6 years in the making, this Texas facility wastes nearly 40% of the leather that's used in the production. Worldwide, LVMH's facilities waste up to about 20%. So the rate of waste coming out of this LVMH handbag facility in Texas is incredibly high. And that's not because they're using worse inputs. It's not because they're using worse machines. It's simply put that the labor pool that's been afforded to them, it's not an expertise in this skill set right now. Whereas if you go to stand up a supply chain and you do it in Asia for these, I wanted to call it less advanced or less skilled, but lower advanced manufacturing, certainly not what we do here in the United States, you have plenty of people who have been doing this now and who have evolved with the industry over time. So that it's a really, do we want to reshore? Yes, we need more manufacturing capacity. Is the manner with which we're doing it going to help? Well, if we look at the results here from one company that has tried to reshore textiles, it's having a difficult time finding the quality that it wants to meet here. And that's something that needs to be fixed. You mentioned the auto parts there, Dylan, though. We've typically looked at AutoZone. We looked at O'Reilly here, ORLY. Both these stocks are obviously incredibly difficult to trade. They're better indicators than anything else. Not only are they trading north of $1,000 or $3,000, there's basically no volume in the stocks themselves. But they continue to go up here. Today's a little bit of a setback. That's what we're doing right now. We're the companies that are holding up well in this market have domestic supply chains already stood up. They don't have to go abroad. That isn't going to cause a big distraction or big disruption. That's the simplest reason why we're not out of the woods right now. Mike, how does this tariff flip-flop on a day-to-day basis? Are you getting into boy who cried wolf territory right now? Because I kind of feel like the market's back there with we're taking this seriously, but not necessarily literally.
I think it's just amazing to see the speed at which the market moves these days based on a perceived reaction of tariffs on, tariffs off. Like that move on the 9th was one of the craziest things I've ever seen. That was the day that set the record for the NASDAQ intraday range, I believe. And it's just, I think the market is ready to click the buy button if things roll back. And we saw that. We were on the show when they initially came out. We saw the initial 90-point run up on the 10% across the board. And then it was like, wait. Let me get this poster board and show you that it's 10% minimum across the board. And then the market's tanked, 300 points from that point. So
look, I was taking crazy pills dragging that onto the screen, Mike. It's like, are we squinting and looking at the tariff rates on this?
That was wild. I was like, is that my poster board from back in the day, science project? Yeah.
This feels personal, by the way. He puts the tariffs on during overtime. He announces the pause during futures power hour. Like, yeah. Can I get a break?
He's watching you.
Please.
Yeah, I think it's amazing to see the speed of the markets. But yeah, I mean, we're seeing moves that we haven't seen in currencies. We're seeing moves that we haven't seen in agriculture. Like everything is reacting, it feels like. And now we finally have this pause, and it's ominous for sure. But it creates trading opportunities, and really, like we'll say it till we can't anymore, but it's really all about risk sizing and making sure that you have the ability to take advantage of a future opportunity if you see it, and not getting too crazy with your opinions. Because everyone, if you're in this game, you will be wrong eventually. You will be You will be somewhat wrong. You will be very wrong, and you just need to be able to withstand the very wrong situations.
Well, Mike, what's your young Batista was with us yesterday, and his one of his myriad opinions was that now is a good time to buy volatility. Now we're approaching, and I'm sure today helped in that regard, an opportunity to get long volatility. That this sort of momentary, hard stop on the range and the related vol contraction is a great opportunity to get long volatility, because there's no way this doesn't get wacky again quickly.
Yeah, so it's interesting because so let's rewind to last year, 2024, buy the dip mode. The reason why we were in buy the dip mode was because we would see these 100-point or 200-point sell-offs. We'd look at the volatility curve and we'd see, oh, volatility has increased, but it's still at 20 or 19, and we were in contango. And when we're in contango, for me, it's like, okay, we might see further downside, but as long as we're in contango, I expect this to get bought up pretty quickly. The difference now is that volatility is contracting, but we're still in backwardation. And to Nick's point specifically, backwardation can really help the positive moving volatility products like UVXY, VIX. That can help them catapult to the upside. And products like SVXY, as long as we're in backwardation, SVXY will drift lower because it's a percentage change on the near-term cycle. And if you're selling out of near-term and you're buying a less expensive back month, you're gonna be creating this drag on a inverse product where it will create a drift on a positive product or a positively correlated product. So I'll never forget when we were in COVID, we had a 15-point backwardation. We have a 5-point backwardation now between J and K and a 1-point between K and M. In COVID, I was watching UVXY and VXX move, and we would have a 200-point rally and VXX and UVXY would not move. We'd have a 200-point sell-off and UVXY and VXX would catapult. And then same thing, we'd have a 200-point reversal, those products wouldn't move, and then they just keep going higher and higher because the backwardation was so extreme. So I think right now, if you believe that volatility is going to expand from here on out, you're kind of getting this embedded floor, not necessarily a guaranteed floor or anything like that, but you're gonna see these volatility products stay elevated as long as we have a 4 or 5-point backwardation, because those products are gonna have a hard time dragging down as they would naturally in a contango environment.
And I mean, so, but would you go so far as to originate a long volatility position tomorrow morning ahead of the Powell speech, for instance?
Yeah, you
and
totally
on the
could.
back of 2 days of mellowing out, basically.
Yeah, if you had the ability to, and you had the cojones to do so, and really another thing that's even more interesting is like when you think about the best way to trade volatility products, it's just with like long calls. Like that's simply because when you get
You're saying just long S&P calls at the money and just let the vol expand there.
well, no, like a long call in VXX or a long call in UVXY.
I see.
Or
Okay.
or the VIX, because when you think about these volatility products, if you expect them to go from, if we're looking at the VIX, if you expect the VIX to go from 30 to 40, the increase in the VIX price from 30 to 40 will increase the overall extrinsic value across the board. But on the way up of the VIX going from 30 to 40, you're also going to have the implied volatility of the VIX increase, which also increases the extrinsic value. So if you're trying to trade like a 1 day or 2 day pop in volatility, the best possible trade with the most ceiling potential is really just a naked call. But it's also nice that it defines your risk. And it's hard to time, and it's a risky trade, which is why I still prefer to buy SVXY at lower prices and then wait 6 months. And if we get back into contango, SVXY will be at a higher price.
Makes sense to me, Dylan.
Can I get you? I mean, listen, can I get you into a VXX call at the open tomorrow, Vecchio?
A VXX call at the open. Interesting. Look, I think there's a really
pre-Powell VXX call among friends.
I was talking with Tom and Tony about this morning in a similar way, where, kind of just continuing the conversation. I thought it was interesting that yesterday Nick mentioned that maybe we're closer to a floor in vol than the ceiling right now. And so I flipped it over to them, and both they, of course, said, no, vol is mean reverting, so even if it goes back up again, it's still going to revert back down to the longer term averages over time. Powell's a really interesting catalyst for all this, because as we've seen him speak recently, the market kind of feels good about Powell going into it. And then he gives us the dose of reality, like, sorry, folks, we don't have enough data to do anything yet. We can't help you. And then the markets go, oh, yeah, right, we can't, he's not going to help us. Maybe that's what we're waiting for tomorrow. Powell, just to remind everyone, we don't have enough data or information from inflation or jobs or growth to determine whether or not it's time to cut rates yet. And we've seen in recent weeks how those cut odds have come back onto the table, at least for June. There was a brief spike last week where they rose back up for May as well. Those have since subsided. It was 55.50 or 55.45 last week for May. It's now back down to 17.82. 17.82. It's not happening. So maybe the market won't be so upset to hear that a May cut's not coming. But I just don't think that messaging from Powell's great. And Bill Dudley, former central banker, was out today in Bloomberg with an op-ed. The central bank should not bail out Trump, should not enable Trump's economic policies. So it feels like the Fed world is sending very clear signals that they are not, coming with Gandalf and, the riders of Rohan over the hill anytime soon to save Helm's Deep. So yeah, volatility tomorrow up, Dylan. I could see easily Wednesday. And then, Mike, we're going through the expiration.
But you're saying Tom and Tony wouldn't play your game of buying volatility because of their mean reversion sort of rhetoric, which is more academic at this point. I'm just saying situationally, if there was ever a moment to buy a little volatility, tomorrow morning seems like a good moment to do so.
I don't think they were on board with the view that Nick was explaining. Although, Mike, it feels like there is a rational basis for looking at this particular moment in space and time and saying maybe we're not out of the woods yet.
Yeah, I think just from a very objective point of view, when you look at the makeup of VXX and UVXY that are positively correlated to the VIX, these products will drift higher or at least stay afloat as long as volatility is in backwardation. The futures volatility curve is in backwardation, and that's what we're in right now. So it's still a risky trade because don't get me wrong, if you're wrong and volatility collapses in a big way, you could see the backwardation go flat or even go into contango in the crazy scenario. And that's when you see these products just get destroyed. But if that's not the case, and let's say volatility increases a little bit and you see that backwardation widen out, then VXX and VIX are going to spike for sure. And especially to a stronger degree than they would if the VIX was at 13 and you just got a little bit of a sell-off where the volatility curve was still in contango. Like we haven't really traded these products since COVID, like literally, because volatility was so steep in contango. And even when we got the 100-point, 200-point sell-offs, those were bought up immediately. So it was like the volatility markets were just ignoring any kind of near-term sell-off because they were gone in a week. Crazy times.
It's a really fascinating market. The other night on First Call, I think what Tom was saying was very insightful, which I don't think many people hear when someone says, "Oh, you just got to be subjective," right? If you got something working for you, take it, run with it, move on to the next trade. If it doesn't work, cut it, move on. This is a really unique. Josh is going to kill me for that. This is a unique set of circumstances here that arguably there aren't many times in market history where it's been like this. Maybe COVID, maybe the end of the Cold War, maybe when the gold peg is removed in the early 1970s, right? You go to free floating exchange rates. I mean, but this has the potential to be one of those situations. So I'm taking it day by day, guys, and just making sure that risks are limited, and moreover, not leaning too heavy one way or the other in terms of beta, right? So if you're really short and we get a headline here, the market's shown the propensity to rip. And if Howard Lutnick speaks, the market's shown a propensity to go down. And we haven't heard from him since Sunday. So I feel like he's going to do it again.
What can I get? Can I tempt you into my short euro long dollar situation? If I can't ease you out into the long volatility world?
Maybe. Europe for all that's going well for it right now, right? It's going to have a lot of money coming into it. There's a lot of fiscal spending when it happens, right? New military. There's new alternatives now other than the US. That should keep the euro afloat. But is it a reserve currency? Absolutely not. No way. There's no fiscal union. It does not have a deep enough, liquid enough, unified bond market for that to be the case. You can't have Spain and Italy and Germany and France operating on different fiscal schedules in that regard. Can't be Japan, can't be South Korea. No one's going to trust China. Certainly not going to be any Middle Eastern country or Russia. So if recession hits, right, the US is not going to buy the stuff from Europe because we run a trade deficit with them. That's a lot of demand leaving Europe's shores. They are not out of the woods for recession either. And if Europe goes into recession, they just fired their fiscal bullets here, Dylan. You just fired your fiscal bullets that took an arm and a leg to get past through that fractured German parliament right now. And if you go into recession in Europe, what fiscal bullet do you fire? Is it going to be the ECB who cuts rates at a time when the Fed is sitting on its hands? Right, then the rubber band of those interest rate differentials can snap back into place. So I'm starting to pay more attention to how central banks abroad are behaving now relative to the dollar. RBNZ cut rates the other day. Bank of Canada is going to soon be back on the ring path. The ECB still has some cuts to go, perhaps. But yeah, recession is we've talked about it here in the US as if the rest of the world is immune. Nick Batista said it very succinctly yesterday. If the US goes into recession, so is everyone else. Nowhere else is ring fenced right now. That's, as Ilya would say, then perhaps.
But that sounds like a long dollar argument if I've ever heard one.
I think we can get to a place where if we avoid an immediate liquidation and collapse of the US's place in the global system, right? If we're not extricating ourselves out of it completely, it's more of like a Brexit. That is probably going to be a slow bleed, and we're done with the the most aggressive part of the leg here, but we need some stability. The whole, as like a macro person, this whole what if we were to, hold on, let me take a step back here. Mike, you've watched Rick and Morty, have you?
Yes.
Okay. When they go fight the Galactic Federation and they change the numbers in the system, $1 no longer equals $1, the whole entire thing falls apart. We're not quite there yet, but when we mess with the role of the US dollar in the global trade system, where we stop telling the world that you're no longer going to buy our biggest export, US Treasury bonds, it draws into question the 1 = 1 part of the equation, which, maybe a bad analogy here, but it's the closest thing I've got right now, Mike.
And well, no, I think it's good, at least good in the sense of like the basic underlying assumption, which is the biggest economy is a reliable counterparty, is the core assumption of the global economy. And when that gets even marginally questioned, it makes everybody pretty squirrely. And that's why you saw the dollar move, obviously.
Well, we still have another day to go for overtime. 2 more days this week. Maybe, oh gosh, yeah, 2 more days this week. Friday is off. So we're halfway through the trading week here, folks. Maybe we get some more action Wednesday, Thursday. Of course, Mike, we have expiration coming up. We have a Fed Powell speech. We have some more earnings around the corner. Keep in mind, if you're trading Netflix for the earnings, you probably want a little bit more duration on your side, because if you place it Thursday, markets close Friday. Other than that, though, we have a busy lineup here tonight on tastylive. After this, of course, macro money coming up. I'm at the bottom of the hour with Errol and Gus. I'm then back at the top of the hour with Victor for the price of truth. So if you liked what you heard here, you're going to get more of it. For Mike Butler, thanks for coming in today, Mike. In Chicago, we have Dylan Radigan Milan. I've been Chris Vecchio in New York. Good luck trading. We'll see you all in a little bit. Stick around, though. More Tasty Live after the break.
If you missed the live show, here's our cherry on top weekly recap.
Well, we got Nova Vanetta today. She's out on a secret mission. Is this correct?
She's on a secret mission in New York City. But yeah, we're doing a funny little promotion, and we're going to see how it goes. And there's an outside chance, very small chance,
She gets arrested?
Yeah.
So you guys sent me to New York to deface a national treasure, and I did not get arrested. No, in partnership with a testicular cancer charity, we mounted cherries onto the back of the Charging Bull on Wall Street, and it was awesome. We did a test run last night at midnight. People went nuts for this. Some guy yelled at us, and this other guy was like, oh, he's just cranky. But it's all for a good cause. We're out there for a couple of hours. It took months of planning. It takes 2 people to hang them because that bull's ass is pretty tall. So that's why I'm in New York.
Those cherries got some good hang to them.
Mm-hmm.
Yeah.
Friday might be interesting. I'm not allowed to work on Friday. I have committed to my family because the Golden Prince is getting married.
I know. Congratulations.
So I have committed that I have to do family stuff, like take pictures.
I'll take things that Tom excels at for 100, please.
I'm just going to be a good
attentive husband and father to the groom.
I'm never a good attentive husband. What I'm probably best at is
dancing. I watched you at the last wedding. You really excel at dancing.
I excel at picking up the tab.
My big question for you, and you know Slappy as he's gotten older.
What do you want to know about Steve?
Do you think after dinner, it was his 60th birthday?
No. Don't do it.
Beth knows Tony better than I know Steve.
Do you think he
I have no idea what you're talking about, and I am just going to move on from this conversation. I'm with Beth. No.
That was like Minority Report, like a pre-crime Omaha. You know, like she knew the Omaha was coming. Like she got the little ball that came down and was like, okay, Tony's gonna go there.
Get the full scoop by checking out the archives at tastylive.com.
And we get another soggy day on Wall Street, limping a little bit lower, but ultimately not really breaking down. Frustrating those of us that are tilting bearish on this stock market after the Fed's announcement last week couldn't get the speculative juices flowing in a lasting way. And so today, while everything else is in grass is growing, paint is drying mode, we are going to focus our view on crude oil. Because here we have some more interesting developments here and the possibility that something of a time bomb is starting to quietly tick in the background. So what we're going to do here is get a little bit of a state of play on what exactly is going on and where prices have been, where they're going, what is perhaps the reason why they're here, and then try to see what could be the next move and establish for ourselves then how that might work out as a trade setup, perhaps at some point here in the relative near term, as we sort of stretch the bounds of credibility for what's been going on up to now. So here's a look at WTI. This is the West Texas Intermediate, US-based benchmark for crude. And what we broadly find here is that the trend has been cautiously pointed higher basically since the beginning of the year. So we found a bottom right under $68 a barrel right mid-December or so, and revisited in that direction at the beginning of the year, didn't set a new low, and since then we've had this kind of slow creep higher, where at this point, with everybody kind of focused on stocks and AI hype and everything else, it's almost lost in the conversation that crude oil is up nearly 23% so far this year. And we're only 3 months into the year. And at just under $63 a barrel here, so right around here, where it's sort of oscillating, we're at the highest levels in about 5 months, going back to here, early November. So there is clearly a conversation here about this being one of the standout performers, not as explosive certainly as we've seen in equities or perhaps even in Bitcoin, but a nice quiet narrative that has really played out independently of anything that we've seen vis-a-vis the Fed, anything that we've seen vis-a-vis broader risk sentiment, a sort of quiet pocket of the market where little by little, we have very significant gains from the start of the year at this point, seemingly divorced from the broader macro narrative. There's a little bit of data that's going to hit us this week. We're going to get first the weekly numbers for crude inventories. And what we find here is that recently these numbers have been significantly more supportive than expectations. So we can see here the past 2 weeks, we've had significant declines, 1.5 million barrels, almost 2 million barrels, against expectations for increases. This is obviously more supportive because when inventories come down, that means that there is a draw from those inventories, so ostensibly supply is being drawn down, and that should be a boost for the price on some level. We're expected to see another decline this time, down 1.3 almost million barrels to be reported this week. It's a similar story downstream when we get to refined products, and here's gasoline inventories, and we can see that they've been declining for a few weeks in a row now, 7, and we're expected to see the 8th consecutive week of drawdown here again. And we can see also this too has surprised in a more supportive direction. So we were looking for declines here of 2 million, 1.3 million, and instead got declines of 5.7 million, 3.3 million. So the pull from gasoline inventories, which then one might expect to have downstream effects, a pull from crude inventories, which then might have an effect on boosting prices to refill those stocks. All of that seemingly lines up, assuming it works out broadly in line with expectations or with this pattern of utilization overshooting, these drawdowns overshooting that we've seen over the past several weeks. All of it seems to line up to a tailwind for crude. However, if we look at the picture slightly broadly, if we back up a little bit and take a broader perspective of what's actually occurring here, there is a very significant disconnect. The U.S. is at this point producing more crude oil than it ever has in history. We are at 13.3 million barrels a day. That's more crude oil production than we've ever seen at any time. What we find is that as this is occurring, broadly speaking, crude oil is about anchored. So obviously there was a major decline during COVID. That much makes sense. As a matter of fact, what we saw then was a pullback that really brought us very, very dramatic reductions in price, in production. You can see that here, production falling off a cliff, the price falling off a cliff because the economy essentially got stopped on both counts. Since then, production has rebuilt and established a new record high. Crude oil has rebounded, not surprisingly, because economic activity was restarted. But this period most recently, call it 2023 onward, what we find is that even as supply increases, the price is kind of oscillating. It's kind of stuck here, which seems a bit counterintuitive because, of course, more supply, you'd think, means the price ought to be at least somewhat pressured lower. So let's put a question mark on that and keep looking at the dynamics of this market to see where maybe an answer is hidden. Not only are we at record high output, we seem to have gotten a lot more efficient at getting there. Notice what's happened since COVID. Here's the COVID recession right here. In the red is the number of fracking rigs that are operational. In the blue, the number of overall oil rigs. And do keep in mind that they're on separate scales here, so this is not actually above this in numerical terms. This is somewhere between 200 and 300 fracking operations, and this is somewhere between 300 and 600 rigs. So we can see here, more importantly, that as we've gone to record highs on output, again, here's the COVID drop. So after the COVID recession, here is the steady build in output. We've had a bit of a recovery in the number of both traditional and fracking rigs, but a significantly lower high than what was there before the pandemic. So not only are we producing a record amount of crude, we're doing it much more efficiently. We're essentially doing a lot more with less. We need far fewer, it seems, active rigs of either stripe to get to these record levels. Now, U.S. oil consumption averages about 20 million barrels a day, give or take. At 13 and a half almost million, we're producing almost everything that we're using, but it does leave a little bit of room for imports. Maybe there's a clue there. Well, as it turns out, imports have been basically flat since COVID, haven't really gone anywhere, whereas exports are increasing at a relatively healthy clip. In fact, you can see until the shale revolution really gets us underway in 2014, the U.S. isn't much of an exporter at all. Imports have been steadily declining for years, but it's really with the spike blow up in shale, where fracking really gets off the ground, that we start to build and build and build and build and build more and more and more exports. And we can see the incline after a bit of a hiccup after COVID has been reasserted. So much so, as a matter of fact, that at this point, the gap, and this is a 4-week average, this is weekly data from EIA, the gap has been narrowed to a meager 2 million barrels a day that we're importing. Now, if we consider that it's taken us a much smaller number of operational rigs to get to record output, closing that gap seems not exactly like a tall order. Not only that, but spooling up production and then storing excess output that may not be consumed immediately, that seems to be something that is relatively easily set up when we consider how much capacity we're using. If we look at the major facilities here, we can see that at the highest level, we're looking at about capacity utilization of 60%. So looking at storage here, we could be storing a lot more. We could be filling up this storage to a greater extent, which means that if we really had to get to complete energy independence in the United States, which is still the biggest user of crude oil, then we could do it in relatively short order. It would not be the world's most dramatic adjustment. And so this once again raises the very important question, okay, well, if this is what's going on, why is it that crude oil is trending higher? If we have tons of supply, indeed record supply, so much so that we're exporting more and more without imports growing, if there's ample storage capacity and all we need to do is export a bit less and store a bit more to get to a point where domestically the U.S. could be completely energy independent and rely not at all on external sources, Obviously, there would be an adjustment. That adjustment would have a bit of a shock on the market, but these are not insurmountable gaps by any stretch of the imagination. Then the question becomes, well, okay, so what's going on here that crude oil is up since the beginning of the year? Supply and demand dynamics certainly don't seem to line up there. Perhaps this is OPEC. We constantly see headlines about OPEC cut output. Maybe this is what's going on. Maybe there is a global imbalance that's echoing back into the U.S. Well, as it happens, when we look at OPEC's output, even when we look at the broader OPEC adjacent producers included in the mix, the so-called OPEC plus, that includes Russia, includes Brazil, most recently. Angola has actually left the grouping. But if we look at this does not look like OPEC is really doing much of anything. And of course, we've argued long and loud here on Macro Money for a long time that OPEC has been largely ineffective at enforcing its collective output targets because they can't get all the members to actually stop cheating. And so what happens most usually is if the price of oil is falling, people produce less because they're not in the business of selling cheaper oil. But it's the price that leads the production, not the production that leads the price. And indeed, we can see here, OPEC output has not really gone very much of anywhere in recent years. It continues to basically idle. Now, these are, of course, estimates, so keep that in mind. But nevertheless, what we're looking at here is not exactly a dramatic retrenchment on supply that would give us a global shortage and bid up the price at the same time that the U.S. is only producing more with ample room to store. So it seems like, again, we're left scratching our heads as to why crude oil is doing what it's doing. Helpfully, the Energy Information Administration, that's part of the U.S. Department of Energy, produces production and consumption estimates globally. So we can actually take it a step further still and find here that production is outstripping consumption by a meaningful margin. In fact, a margin that seems to be generally approaching kind of 85, 86 barrels, million barrels per day globally. So again, this is not seemingly a supply-demand story because there is more than enough supply for the amount of demand. And this includes not just crude, but overall liquid fuel consumption. So with all of that in mind, this still needs an explanation. Now, the obvious one that jumps out is geopolitical. We still have a war that's ongoing between Russia and Ukraine, where both sides have increasingly taken to attacking each other's energy infrastructure. Russia is shooting rockets at big pockets of Ukrainian storage. Ukraine is running suicide drone attacks at Russian infrastructure, both oil and gas. So there's certainly a level of scary headline flow there. On top of this, we, of course, have the conflict in the Middle East, where the terrorist group Hamas provoked a war with Israel. And now the Yemen-based Houthi rebel group, which is another Iran-backed group like Hamas, they are sympathetic to Hamas's cause, and they've taken to attacking the tankers that pass and other commercial vessels, in fairness, that pass through the Red Sea on their way to the Suez Canal, which is, of course, how oil from the Persian Gulf gets into the Mediterranean and to Europe. So, again, seemingly there is a reason to be concerned. Now, whether this has actually had any real impact on market dynamics is suspect, because if we look at this stage at the spread between the price of U.S.-based crude, and as we've just argued, it's overwhelmingly such that the U.S. could be energy independent, produces a ton of the crude that it consumes, and so there really ought to be something of a discount for U.S. crude. A discount would be normal. And the spread between that and the more international Brent benchmark, which is angled around North Sea crude, and that would be where you might see a premium build up around these supply disruptions in the Middle East and Europe. But as it happens, since about 2013, the middle of 2013 onward, the gap between the prices here has been a fairly steady $5 premium on Brent relative to WTI, and it hasn't really gone anywhere. The bottom of the range is about a $12 gap, where Brent is about $12 more expensive. The top is about $3, where WTI is about $3 more expensive. The middle of the range is around $5, and we're sitting right there. So it doesn't look like all of these geopolitical disruptions are actually having any real effect. But that doesn't mean the markets can't build in a risk premium into prices on a speculative basis. And so what this becomes then is something of a time bomb, because it isn't economic reality, supply and demand, that seems to be accounting for crude oil being higher, even when we take the disruptive nature of geopolitics around the key production routes at the moment into account. It's that the markets fear there might be some sort of real world consequences on supply disruption eventually. And so invariably, if the markets are continuing to discount, and if those disruptions don't actually occur, the longer they don't occur, the more vulnerable this becomes to the flow of negative headlines eventually drying up. Needless to say, the Israel-Hamas war will end eventually. The Russia-Ukraine war will end eventually. We are then vulnerable inherently to any kind of a headline suggesting we're anywhere closer to that end on either front, separating us from what could be a significant decline in crude. Now, do we have any current signaling to suggest that is imminent? Arguably, no. But if we were to get underneath, give or take $80 a barrel here, this former resistance become support, we might guesstimated as something about here. If we were to break through this on a closing basis, a trigger might well be immediately in front of us. If we were to take a slightly longer term view here and look at it perhaps as a bit more broad, then we could perhaps guesstimate something like this here as a kind of supporting range between about 80 and 78. And if we were to get through that all the way down to here somewhere, then maybe there's a much larger reversal. But at this stage, we don't have that confirmation. What we have is a market that's seemingly looking to headlines for its support, and were those headlines to turn or even offer something of a tone shift, the whole thing might unravel. And that is macro money for today. As ever, we are here right after overtime, show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow thereafter. Back on with Chris for Futures Power Hour on Fridays, though probably not this week since we have a market closure for the Good Friday holiday. I'm back on with Tom and Victor for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. See you tomorrow.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide. Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
If you missed the live show, here's our cherry on top weekly recap.
Well, we got no Vanetta today. She's out on a secret mission. Is this correct?
She's on a secret mission in New York City. But yeah, we're doing a funny little promotion and we're going to see how it goes. And there's an outside chance, very small chance she
gets arrested.
Yeah.
So you guys sent me to New York to deface a national treasure, and I did not get arrested. No, in partnership with a testicular cancer charity, we mounted cherries onto the back of the charging bull on Wall Street, and it was awesome. We did a test run last night at midnight. People went nuts for this. Some guy yelled at us, and this other guy was like, oh, he's just cranky. But it's all for a good cause. We're out there for a couple of hours. It took months of planning. It takes 2 people to hang them because that bull's ass is pretty tall. Yeah, so that's why I'm in New York.
Those cherries got some good hang to them.
Mm-hmm. Yeah.
Friday might be interesting. I'm not allowed to work on Friday. I have committed to my family because the Golden Prince is getting married.
I know. Congratulations.
So I have committed that I have to do family stuff, like take pictures.
I'll take things that Tom excels at for 100, please.
I'm just going to be a good,
attentive husband and father to the groom.
I'm never a good attentive husband. I could be. What I'm probably best at is
Dancing. I watched you at the last wedding. You really excel at dancing.
I excel at picking up the tab.
My big question for you, and you know Slappy as he's gotten older.
What do you want to know about Steve?
Do you think after dinner, it was his 60th birthday?
No. Don't do it.
Beth knows Tony better than I know Steve.
Do you think he...
I have no idea what you're talking about, and I am just going to move on from this conversation. I'm with Beth. No.
That was like Minority Report, like a pre-crime Omaha. You know, like she knew the Omaha was coming. Like she got the little ball that came down and was like, okay, Tony's gonna go there.
Get the full scoop by checking out the archives at tastylive.com.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, cover calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
What is going on, everybody, and welcome back to Risk and Reward. We're back here with Gus and E. We got a special guest today. We got Chris Vecchio in the house. I'm going to pick his brains on some of the thoughts on the current market environment and whatnot today. But Chris, so good to have you here. What's going on, guys? How are we doing today?
I'm doing good. Yeah, excited to have Chris here. We were just having a spirited discussion about calf development while we were off air. It was a fun one. We should be a fun time. How you doing, Vecchio? Yeah. What's going on?
Thank you for having me, and thanks again for filling in during Futures Power Hour today. Good to see that you guys were on air, and so I figured I'd return the favor and come join you to round out the afternoon session.
Yeah, you were dearly missed by your fans at noon today. We were quite the disappointment for everybody. So yeah, happy to have you. Happy to make it up.
Very untrue. That's obviously untrue.
No. We are into the fourth month of the year. Things have been pretty crazy so far. I kind of want to dive right into the markets. But before we do, outside of the markets, what's going on, Chris? What's new? How are we doing today? I know this is a little bit of a different time segment that you're in, but Gus and I were chopping it up a little bit. There's a few things we want to throw at you, so I hope you're doing well. But we just want your thoughts overall. Gold, tariffs, just base headlines, nothing too in the weeds, but your overall take on it. But before we get into all of that, how are we doing? We're in the fourth month of the year so far. How are we holding up?
We're holding up well. The last week's been a little bit better. Gold coming off the board hurt me, but it bouncing back the way that it did has been very, very, very helpful to making me keep the ship steered in the right direction, considering how much I was hiding out in gold. I've been very tepid this year in stocks, and I think now in hindsight for good reason. And more importantly, the Mets are 11-5 and in first place, so I'm really feeling good.
11-5.
As a Mets most wins in the month of April ticket holder, I have been keeping up with that pretty intently as well. So hopefully that'll pay off for the both of us.
Good. Yeah, I've been sensing that there may be some more closet Mets fans in the office. Mike Butler was telling me yesterday how he needed Clay Holmes to have a big game, and sure enough, he did exactly what needed to be done. So it's welcome. Being a Mets fan sucks. You're gonna hate it.
I'm a Reds fan. I can relate to having a crappy baseball team here and there, but I suppose no other team in my city bringing me down as well.
The way that I see it, that's a great character. That's a great characteristic. I mean, Mets fans are loyal. So, Chris, I know you're a loyal guy, brother. So, tough times.
That's true.
Absolutely. I kind of want to just bring up gold here, too. I know gold has been really the talk of the town, and just get your brief thoughts on that, Chris. But so far, especially for a younger generation, what is a headline or what is a catalyst to why gold is really popping off right now? Does this have anything to do with the tariffs? Is it the fear, the overall uncertainty? What do you see from your view?
Yeah, I think it's the tariffs, and I think the simple explanation is that the United States' number one export to the world are U.S. Treasuries, and if we're going to be reducing our trade with the rest of the world because of these tariffs, then people are going to have fewer treasuries to buy, and that really underpins the stability of our economy and our country. So, do you think if the United States is pulling back from the system that it constructed, it's going to be a reliable counterparty over the next few years? That's probably yes, but it's now a bigger question than ever before. And is there another currency to fill the gap after the dollar? No. So what do you turn to? That shiny rock that's been around with us humans for time immemorial.
Yeah, it's not looking like Bitcoin is becoming the new gold standard. Not now, at least. Crypto is seeming like it's beginning to seem very correlated with just the overall market sentiment in general. But gold has been just absolutely going ham. So I wanted to get your thoughts on that. Any thoughts on the 10-year Treasury and things on that side of the market, Chris?
If the plan is to bring rates down, I'd say they're not doing a great job thus far. There was some talk that a fund blew up. There was a Bloomberg news story today that one of Alpha Dine's flagship funds was liquidating its Japanese equity and bond exposure last week, and also then selling off treasuries to cover losses. We had some talk about a basis trade blowing up, which for those that don't know what it is, financial institutions, hedge funds, they get long the cash bond and then they short the synthetic future. And if they hold to expiry, they earn the basis, the difference between the two contracts, net transaction fees. And that's basically free money in normal market conditions. But when people start, selling their, short-term treasury holdings in order to raise capital, that basis trade blows out. And all of a sudden you have this big losing position on your hand. So there was some stress last week. Yields are going up. That's not great. If we're not questioning our country's role in the global economic system, then yields can come down, and a recession, if that is coming, is probably going to be good for lower yields, if not by the Fed, but by virtue of growth expectations coming out of the market. So I'm still leaning long deltas net between notes and bonds. Last week wasn't fun, but we're basically where we were when I got in, several weeks ago. So I'm not really too concerned. It's uncomfortable.
No, absolutely. A lot of
how are you guys, though? More importantly, like as traders to the market, right? Are you using TLT? Are you using ZN, ZB? How have yields influenced your thinking, because they haven't been a safe haven during the equity market decline?
No, I mean, I can't speak for Gus, but I mean, in terms of times of uncertainty with this, and in terms of being in the market for less than 10 years, not as much experience, it's been more of a learning experience, more from the sidelines, watching the yields, seeing different headlines be released, seeing interest rates doing X, Y, and Z, and just watching from the sidelines to see how things react, to have to be a little bit more comfortable entering some of these positions. So it's been a learning experience, I can say, overall for myself. Been taking advantage of all the volatility, but just to wrap it up in a short sentence, position sizing and risk management, regardless of the treasuries doing this, NASDAQ is putting in 1,500 points in 30 minutes. What's been top of mind is really just managing that risk. But other than the treasuries, it's been a learning experience. What about you guys?
Yeah, I would say that I fall perfectly in the same line. I think that this has all been quite the learning experience. I've mentioned on air before, but I started trading in March of 2020, so right in the middle of peak COVID, and at the time I was trying to figure out what a call option even is. So I didn't really have the bandwidth at the time to keep up with the treasuries, see how all that moves, see how the Fed decisions and Fed meetings play into all of this in the macro. So yeah, it's been a learning experience. Nick could attest. I badger him about TLT from time to time and try to figure out how this whole picture comes together. But yeah, as Errol said, just a great lesson in risk management, and also avoiding directionality in times of hyper uncertainty. I certainly got burned a few times with false bottoms on the way down there before the gigantic dump, and so yeah, just learning how to profit without directionality in times of extreme volatility. And it's been a great learning experience. I agree.
If I could just draw a parallel there, I go to college in fall 2007. So my first, after freshman year, is summer 2008. And my first job, I actually working with, so I get to see the oil spike, which was a lot of fun. But likewise, the oil goes up to 150 a barrel those years right before the recession hits. But then I remember, Ilya is one of the first people I work with. And I start asking him these questions about how the markets function, this, that. He's actually like, forget everything that you've learned. We're in the midst of a crisis. Like, what? Excuse me? I'm learning how to trade in a crisis. So
Yeah.
Gus, I feel, I mean, like, it's actually one of the best times to learn because it's not theoretical what happens when stuff hits the fan. You see it play out in real time. And I would encourage younger traders, take notes, journal throughout all of this. Multiple times a day, perhaps, what you're thinking when you see these headlines, the price swings here. That way, in a few years, when we go into the next crisis, you can kind of look back and say, okay, how did I handle this? What did I do well? What didn't I do well? Make that part of your trade journal. If you don't do it, I think it's a worthwhile exercise. And certainly I've leaned on that in my experience here to avoid making mistakes that I've made during past episodes of, market turmoil.
Yeah, I think that's an excellent idea. That's something that's never occurred to me at all, is to journal everything. So yeah, that's really good advice. Go on.
It's very helpful.
No, yeah, I was just gonna say. So is that more so the playbook, right? I know you were trading during the last Trump administration also. So what similarities have you seen now that we're in a very similar market environment in terms of volatility and just trading around that same exact administration? Because I would assume you have some notes of a similar playbook that you might have applied when he was first in office in 2016. So tell me a little bit about that.
Yeah, I did apply a similar playbook. Didn't work out.
Okay.
This administration is not the same as the first administration.
In what way?
The first administration, you had people like you had Gary Cohn in there instead of Howard Lutnick, and there's a joke that goes around in certain financial services circles, like you always hire Goldman over Cantor, and we're seeing why in this administration. But Gary Cohn was a free trader. Howard Lutnick is not. And that's the person who has the president's ear this time around. But I think also the fundamental difference, we've heard it from Trump himself. He used to quote the stock market all the darn time.
Mm-hmm.
He'd tweet about it, Truth Social about it now, I suppose, but he would tweet about it every day almost, every time there was a new high.
Right.
And now he's telling the world, I'm not looking at stocks. That's a huge difference.
That is a massive difference. But I got to ask, what expectation did you have coming into this administration that was the same? Was it the increase in volatility? I mean, I guess that one could have been a little bit more of a given. I think this administration is a little bit more sporadic, so there's a lot more uncertainty. You kind of got to be on your heels and really be paying attention to those headlines. So did it help you at all in the Trump administrations? What parallels do you see from then? I completely understand it's a totally different administration, and coming from Donald Trump's mouth or tweets, he did say he's not looking at the stock market right now. So it is a completely different perspective.
Yeah, I think what did work initially was that there was a path higher for the U.S. dollar. And from his election in November up until inauguration date, really, quite frankly, up until, late March, the dollar from November 2024 up until then, it effectively follows the same path that it does from November 2016 until, February, March 2017. And so coming into this year, one thing that I had put on was, we like to jokingly call it the James Bond trade, the long 007 calls in 6J, because operating from the place of, if we're going to follow a similar path, then the dollar is going to turn lower by the end of Q1, and rate differentials maybe move in the yen's favor. And if something does hit the fan in equity markets, the yen's probably going to get a safe haven bid. All of that amounts to maybe not necessarily the yen directionally going up. It should, but volatility was really underpriced. Like IVRs in the teens, all of that would equate to an IVR environment. So at least buying the options, looking for volatility expansion. So that worked out well. What didn't work out well, of course, is the path forward on equities. I took a few shots in January and February at long in some call spreads that were out of the money. So to find risk, and if they don't work out, it's not a big loss anyway.
Yeah.
One hit, one didn't. And then once we made our way through mid-February and the momentum turned over, I basically stayed away, except for another short put spread I put on an ES on March 14th. And that's almost back to break even after that big pullback. So I've tried, in thinking that it wasn't exact one-to-one because the people he surrounded himself with, I wasn't following the playbook totally, but I did, at least in the currency world to a certain extent, by getting those longer dated out of the money yen calls. And that has helped throughout this whole episode of Tumult in Stocks.
And lastly on that topic, before we shift gears here, Chris, so for you to, because I know you don't want to just stay on the sidelines, you want to take advantage of the opportunity that's there. Is it more so just changing the way you're dipping your toe in the market? Is it position sizing? Is it going a little bit more defined risk? or what is kind of your style or adjustment that you made in terms of the type of positions you put on?
Yeah, so there are times when I'm really confident and I have just gone out and buy, like, I'm just going to buy ES futures and just swing this.
Right.
And then there are times where I like to call it the wedding crasher trade. At the end of the movie, Owen Wilson runs up to the altar and says, "I'm not asking you to marry me. I'm just saying don't marry him." A short put spread, right? I'm not saying the market's going to go up. I just think it's going to stop going down, and then volatility is going to contract around here. So it's definitely more defined risk in that regard right now. I'm not comfortable jumping in with 2 feet, throwing the kitchen sink at it, as it were. I want to see a VIX term structure that's back into contango. I do not like it when it's in backwardation. I don't like when it's flat. And while it's in less backwardation now after the evolution over the past week and a half, it's still in backwardation. So that's not the kind of place where I just go out and buy, where you buy at the money or out of the money calls and go fishing.
Right. Absolutely. Gus, I know you had brought up crypto a little while ago. What are your thoughts on the crypto side of things?
Chris, I wanted to pick your brain on this. I wouldn't say long, but last 6 to 12 months held a view that we are going to see a slow evolution to where crypto will start functioning in the capacity that gold does, where it's a hedge in times of extreme volatility and uncertainty, in a more macro 5 to 10 year sort of context, maybe not in the immediate. In fact, I've gotten burned betting on that in the immediate. But what are your thoughts on that? Do you think that that's something that could ever realistically happen as it's standardized, or do you see holes in that theory? What do you think?
I think it's an interesting theory, and I think there's certainly some potential around the corner. One thing that Bitcoin tends to track very closely, aside from the NASDAQ, and Errol, I think you make a great point about it just basically being a high beta tech stock at the very long end of the risk spectrum, it tends to also track global money supply evolution. And the way that you can track global money supply, I'll share this with you guys so you can put it into TradingView or something at a future date. But you can take a look at like the Fed's balance sheet, take out the reserve, the liabilities on their balance sheet, take out the reserve repo facility in the system, and then rebalance all the asset or the net assets across the ECB, BOJ, PBOC in their local currency terms to take out the dollar component and get an equal measure of how the M2 global money supply is evolving. And if you were to draw that up and pull it up right now, you'll see that it's exploded higher in recent weeks. And it's in part because the US dollar has gotten that much weaker, and it's allowed all of these other currencies in the world that all these central banks hold on their balance sheets to go up in relative value. So money supply has actually gone up. And if Bitcoin follows the same path that it has in the past, then stability in stocks could cater to, okay, we've shunted some money away in this rock that produces no value. Maybe we could put it into some other form of safe haven to get a little bit of diversification, which aside from trading, I think this is a very important point that longer term people like ourselves, because I think we're all 35 and younger here. I don't think either of you are older than me. Studies show on the asset management side in terms of portfolio construction, if you have 3 to 4% crypto allocation over the past decade, you've actually had a lower standard deviation of returns and higher returns, a better Sortino ratio, if you will, or Sharpe ratio, than if you didn't have any crypto in your portfolio at all. So having a little bit, it may not be through BTC futures. It could be something through IBIT, or if you do self-custody, certainly that. But having some in your portfolio for the long haul can be something that's beneficial to diversifying and reducing risk.
Yeah, not to go too off the rails, but have either of you guys read the book or watched the video on Ray Dalio's World Changing Orders? I forget what the title is. I'm just curious if either of you guys have read that or gotten into that.
I'm not familiar myself.
Okay.
Yeah, he has written a bunch of books. He wrote The Changing World Order. That came out, like 5 or 6 years ago?
About 5, I think, 4 or 5. Yeah.
Yeah, he's had a few. He has it's like a 2 or 3 part book series that he's in the middle of writing.
Yeah.
And I think that's the second one.
Mm-hmm.
The concept of regime change. I've talked about this on other shows.
And I just bring this up because we were talking about the strength of the dollar, just to provide a little bit more context, nothing specific, but I would love to hear your thoughts. Absolutely.
Yeah, so when we think of regime change, I know many people would probably think of like, men in green suits storming some presidential palace and declaring a coup. But the term regime change actually comes from economic history to describe what happens when we go from classical liberalism and industrialization into Keynesianism, and then ultimately through Bretton Woods into the end of the gold being pegged 1971 under Nixon. That's a regime change in the economic order. Maybe 1983, you can bookmark another one with Margaret Thatcher and Ronald Reagan. And perhaps we're going through another one right now. So a lot of the underpinnings of the world that we know and the relationships that we know that have guided us may no longer be valid. And that means you have to be very flexible. You can't really rely on like fundamental theory so much right now. You can rely on your quantitative theory, your technical theory more than anything else, because those are studies of sentiment and price action. But fundamentals right now, like all these earnings reports coming up, who cares about what the guidance says? How could any company give guidance in this tariff environment? So like, what information are you going to draw away from backwards looking EPS with guidance that's so, so what fundamentals do you have right now? So you have to you have to find something that works and just find that strategy that fits you and work with it and run with it and then hold on to it tight. And when it stops working, let go, move on.
Absolutely. Let me ask you, what's your approach heading into earnings seasons now that you touch on earnings in this interesting time, if you will?
Maybe I shouldn't say this. I'm not trading earnings right now. I'm also a macro guy, right? So don't take it from me. I'm top down, not bottom up.
But from a macro perspective, mentally, how would someone approach earnings during this time of uncertainty with tariffs right now? What would you expect, not that you're trading him?
I would expect that if we're talking directional, the lack of guidance is probably going to be an albatross around these companies' necks, right? It doesn't really matter what you did. We're looking forward to what you're going to do, and you can't really tell us what you're going to do. It's one of the reasons why I'm a little reticent about the market, the market continuing to move up from here at these levels. I would think that if we can get through earnings season, we get a little bit of pullback. Oh, look at all this tariff uncertainty. This is the kind of final wash through the system, assuming we're not going to see a further escalation of the tariff rates. And then we can finally start doing the whole, okay, these are where tariffs are. We can plan, we can forecast, we can issue guidance. So second quarter for stocks could still be rough.
Yeah, no, absolutely. I mean, it's going to be an interesting time period. I know one position that I'm holding on to right now is Tesla. I just have a put spread sold in there. Again, probably not the most wise thing to do to be holding or selling premium long into a binary event, as we can expect volatility to expand a little bit there. But only reason why I bring that up, we got earnings right around the corner, and just keeping in mind how we're going to manage some of these positions. I don't typically trade earnings too much as I did in my first and second year, but still something I'll take part of, and just more so just soaking in that knowledge of other people's minds and kind of what they might look for in this ever-changing economic environment.
The one thing I think Tom or Tony would point out in an environment like this for new traders, you go on Wall Street Bets, you look at some of these, forums, you're on FinTwit, what have you. And the sexy thing is when someone buys like a 10-cent out of the money option and it prints for $10 because of the earnings. But the reality is there's a reason why that option was trading at 10 cents in the first place ahead of the earnings report. It's a very low probability outcome. You're effectively rolling the dice. We do have vol in the system though still. Yeah. And in this environment, because of that juxtaposition or like that comparative nature of good earnings but can't really give guidance, so where does the stock go? Maybe not anywhere. This seems like an environment for IV crush. So if you're buying out of the money calls or buying out of the money puts, right, the stock may fall, but it's not going to fall as much as you want it to, and volatility contracts. And so now you have this option that's worthless. You were directionally correct, but not, not in terms of the right strike. So the typical tasty way here, I think, will serve people well, right? 45 in, 21 out, vol's high. Look for vol contraction. Don't expect a lot of clarity.
What are you kind of expecting, Gus? How are you kind of positioning yourselves? Just define risk, just being mindful of those things, or where are you at right now?
You mean as it pertains to earnings or just in this environment in general?
I guess a little bit of both, just in general for the most part.
Well, I would echo Chris's sentiment in earnings. I think that everybody, regardless of what they may report about the previous quarter, is just going to say our forward guidance is we don't know, and that uncertainty is going to hurt a lot of companies. But Yeah, I mean, it's something that I've been talking about on the show a lot, but I've been gravitating more towards shares than I ever have in my entire life in this environment. I know that we're near the bottom. I know that in the macro, I believe that things are going to recover. I find it hard to believe we would see SPY under 500 again, or pick. You can pick. So yeah, it's just been a lot of shares, and I'm going to wait out the uncertainty, making money on my shares. And whenever we have a bit more of a definite direction, I'll reposition and start trying to get a bit more directional. But yeah, I mean, it's normie brain dead investing. It's buying the dip, and so far it's been paying dividends for me. My highest earners, if I'm sitting here looking at my portfolio, none of them are options. So yeah, if you feel like you're at the bottom and you don't know when exactly the top's going to come, shares are a good vessel for that. So yeah, keeping it simple.
If it's boring, you're probably doing it right. So hey, hats off to you.
No one ever lost too much money being boring. A little bit.
No, a little bit.
No, but that's the approach change, right? Like things are really crazy. Lay off the leverage, get away from options, go to the shares. You're still playing in the market. You're still staying involved. We have a longer term time horizon than others. And so if we go into accumulation during a market drawdown, that's fine. And then we try to generate the alpha when things relax a little bit.
Exactly. And I have some leaps as well. I got some leaps on Berkshire. Some leaps on NVIDIA, things like that. But yeah, nothing too crazy. Only one position inside of 90 DTE, which is the NVIDIA vertical I mentioned on stream earlier. And I'm being regretted to inform, or people are regretfully informing me in chat right now that NVIDIA has tanked post-market. They got some kind of hit. So I just need that to hold above 100 for one more day. So I'm hoping I don't lose this one at the bell.
Before we wrap, let's take a good look at what's going on right here in NVIDIA. It's looking like we're selling as we speak. We closed at about 113 or 112.19, sitting at about 105 right now. So any short sellers in the house probably out getting drinks right now. So.
No kidding. I would be.
No, that's gonna pretty much wrap. We're coming to a close. Anything else to add, Gus, before we hop on out of here?
No, I don't have anything else. Thanks so much for hanging with us today, Vecchio. I know it's a busy afternoon for you. We appreciate you.
Yeah. Thanks for having me.
Absolutely. Any last wise words to give, the audience before we dip on out of here, Chris?
Yeah, for newer traders, I think a lot of people are trying to find the right strategy that always works. There's not a strategy that always works, right? There's going to be times when the market goes up and down very quickly. The only thing that you can control is how you adjust. And making the decision to make the adjustment is perhaps the hardest thing to do, because you're telling yourself that your initial decision was wrong. And if you just hold out for a little bit, then maybe you'll ultimately be right. I've lost more money doubting that ability, having that loss aversion, than anything else. Like, oh, I should probably get out. Let's just see. No, trust the voice in your head that says just get out. You can always put the trade back on. You don't want to get liquidated. The job is to protect capital, preserve it. That's your main goal as a younger trader. Learn the ways, survive, and then grow.
Survive. Well, it's that the market can stay irrational longer than it can stay solvent, right? I think that's how it goes.
Sure. Trump's tariffs can stay in place longer than we can stay solvent. I think.
Hey, take that with a grain of salt, everybody. Take that with a grain of salt. But no, that's going to wrap up today's segment. Chris, again, thanks for taking the time. We appreciate having you here. And be sure to stay tuned for more segments coming up, and we'll catch you guys next time. Peace.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
All right, yeah, I'll talk to you. There she is. Good, you found the place. Good, you're not stupid. I dated 3 stupid girls in my life. I loved every one of them. So maybe you're the next one. Having a good day? I'm having an awful day. But then it got really good again. Oh, good. So I'm feeling all right. Hey, where'd you go to college?
I went to
University of Penn State Community College. You didn't know they had one of those, did you? Yep, the Fighting Rams.
Oh.
I'm one of the Rams now. Do you have any sexual fantasies? Excuse me? I do. My parents are watching. They're sitting on a rainbow. I'm a half man, half giraffe, and I'm dressed like Brett Favre. What does that mean?
I don't know.
Talking about it gets me pretty hot, though. Uh-oh, there it is. His pants just got tighter. I'm a vampire. Can you believe that? Does that make me more mysterious and attractive? Uh-oh, watch yourself. We don't want to get hit by a car. My brother did that once. He can't talk now.
Oh my God, I'm serious.
Yeah, pretty serious. Are we getting serious? I think so. How many kids do I want? 5? 11? First meal. Here we go.
That was rude.
This is on you. So much time is flying by.
Yeah.
You're very funny.
Oh, thank you.
Does anybody ever tell you that?
Yeah.
Well, you're not that funny, so don't worry about it.
That's interesting.
Not a big fan of Sam's anymore. But now you know everything about me. I feel like I'm opening up so much. God, I'm scared. This thing's moving so fast.
Yeah.
Oh, wow. I haven't cried like this in a long time. Are these tears? Uh-oh, here we are. Front door. Big first kiss moment.
Oh.
This is just moving a little too quick for me. You're a great kid.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're #1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
One of the things that was most intriguing about the financial space to us is just that there wasn't a lot of vision. There wasn't a lot of innovation. After almost 20 years of open outcry standing in the pit trading, I felt like all the markets were moving to electronic trading. I saw the writing on the wall, and I wanted to be first. Building the best technology in the world for traders was one of the coolest things anybody could ever do. I loved every second of it.
Thinkorswim will always be my baby, but this one, it's different. We built ours literally from scratch. It's a much thinner, it's a faster, it's a slicker application. Everything's on one page. So you're always looking at the core page and then bouncing around from there to get to whatever you want to get to. We're here to support whatever you're looking to do. We have the tools that you need to be a successful trader.
April 15th, the taxman cometh a little bit after 5 p.m. Central Time, the best time. You know what that means? It's time for Tasty Live's evening show, a little podcast. A little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world, and we've got a handful more to chew on today. Before we get started and say what's up to the people, let's say what's up to our incredible guest. We have with us the big brain today, my friends. I'm talking, of course, of Christopher Vecchio. Chris, how you doing, my friend?
I'm doing well, Victor. I'm doing well. How are you?
I'm okay. Yeah. Did you finish your taxes?
I have not finished my taxes yet. I need to amortize my fart coin. And
I knew you were going to repeat that. It's not the right use of amortize.
Of course not.
I need to amortize my fart coin.
Need to depreciate my gas fees, and I don't know. It's gonna be a mess.
What a brilliant way to like come into any tax conversation at the water cooler, around work, because people are talking about taxes. Like, yeah. Gonna have to amortize my fart coin. Makes no sense at all.
You're like, those crypto bros.
Well, shout out to everybody watching on tastylive.com, as well as all of you watching Tasty Trade desktop and mobile application, as well as all you procrastinators who have yet to amortize your fart coin and are going to have a long evening. But if you want to be part of this conversation, somewhere in the middle of your screen, bing, did I get it? Somewhere. There's only one place that you can do it, and that's over on Tasty Live's YouTube channel. So head on over there, find the channel, subscribe to the channel, and then start banging away those metacarpals, phalanges, skull, anything to type random ass characters into the chat and spoof the Google algorithm into putting us in front of as many people as possible. Chris Vecchio, shout out to everybody in the chat as well. Chris Vecchio, all looked okay to start the week here. S&P 500 cash closed under by about 0.2%. The Nasdaq was positive by about 0.2%. The Dow Jones under. Sorry, I'm saying 2/5. I meant 1/5. The Dow Jones under by 2/5, and the Russell up by 10 basis points, 11 basis points to be specific. And then we got some news, my friend. And so I'm trying to think whether or not we talk about what was up until the 3 o'clock close, or whether we talk about what's transpired since. And I think it's more interesting to talk about what's transpired since. Have you had time to look at this whole H20 chip situation, this decree?
I have. On April 9th, the government told NVIDIA it's going to require an export license for chips to China and other countries. And NVIDIA says, okay, we're going to have to take a $5.5 billion charge off as a result of this. So the stock's down 5% or so here after hours. It's just another sign of how the tariffs are leading to economic and financial disruption in the short term. If it's short-term pain for long-term gain, this is definitely still the short-term pain part of the cycle. We haven't gone through earnings season yet. And how do you think about it, Victor? What's forward guidance going to look like for these companies, right? You can't really predict it or say. But this charge off here is a stark reminder that even though the tariffs only just went into effect, there's clearly already financial ramifications that we may not fully understand.
Yeah, man. NVIDIA down to 105 and change, 105.5 from 112.20 close. The NASDAQ futures are now down a little bit more than 1%, maybe 1.2% here. The S&P is trading heavy by 75 basis points. To your point on earnings, I thought it'd be pretty straightforward. I thought we would see for most companies, except those that serve the lower end consumer, I thought what you'd see is basically blowout numbers this quarter, much more than expected, better numbers than expected, with pulled or lowered guidance. What I didn't really expect is what United Airlines did not long ago, which was sort of give like two different paths, if recession, then else, which I don't know that I've seen something like that before. I mean, maybe it's happened. I can't remember ever seeing that in a report. And I'll be curious to know how many other companies sort of follow suit with trying to navigate investors, giving them some sense of certainty versus just pulling all guidance altogether, which can maybe spook investors completely away from your stock, especially if there's alternatives and if your competitor is offering some sense of guidance. But I thought it'd be simple. People probably did better than the mood currently expects, and that they're likely going to pull guidance and leave you on your own trying to figure out what multiple, like what earnings number and what multiple to slap on an earnings number. which means like, what are they paying these people for? What are we paying analysts for? And when we get to any sense of uncertainty, they did this in 2022. Just nobody shows up. Nobody gives guidance. Nobody moves their earnings estimates, and it leaves everybody on their own. It's like, I didn't need your help when the distribution was small, bro. You're supposed to be making your money when the distribution gets wide. Your thoughts? What do you think we see this earnings season?
Yeah, I mean, I don't know if the backwards-looking earnings are going to tell us much of anything about the future. We may have had some really nice numbers for some companies. That the banks did really well in the first quarter, as we've seen thus far. But putting forward expectations is difficult, and it's not difficult again because the tariffs are here to stay. It's difficult because we don't exactly know what tariffs are here to stay, and just the whole process is so convoluted right now, Victor. If I import a computer, a laptop from China right now, it's exempted, no tariffs. But if I, as a, say, small business, want to get all the little components to build that computer here in the United States, because I'm a small manufacturer, I'm going to be tariffed out the wazoo still. So like that's kind of incongruent with the administration's stated goal of reshoring and rebuilding domestic manufacturing. And yet that seems to be the incentive structure if you look at the tariffs right now. It's easy for big companies that build their laptops abroad. It's very difficult if you want to do that here in America. So that seems inconsistent. Right? So do you really think that this is the final resting place of these tariffs? Or as we heard over the course of today, there are 130 countries that they're currently negotiating trade deals with. It doesn't seem like this is the final resting spot for tariffs. So how, as a company, can you possibly say we have a high degree of certainty in any regard that our costs of goods sold, our inputs, our raw materials are going to be X, Y, Z? You can't right now. So I think that's an albatross around this market's neck. The only silver lining to all of this, and I am weighing this in my head more and more, we all know this, don't we? We all know that there's going to be no guidance. What investor out here right now is expecting any company to give any sort of rosy guidance moving forward? Mm-hmm. So the bar is very low already. And maybe that's the kind of final flush that we need here to get a bottom in, right? Where we can go through earnings seasons, we get a reminder, the tap on the shoulder, guidance is removed. Yeah, we all kind of knew that, so the market wobbles and sells off a little bit, but doesn't necessarily tank. And I think that would be the best case scenario. We go back to like a year ago mindset. And we talked about getting through the earnings season, and if you got through it and it's not bad, all I got was this stinking t-shirt. Maybe we can go back to that attitude, Victor. But that's why this is so important here. If we all know we're all playing the same game, we're all listening to the same music, then shouldn't it be priced in that the guidance is gone?
Yeah, I mean, there's nothing to price by a company dropping guidance. You still have to price something, So the market still has to go based on what I heard, what I saw in your numbers, and some aspect of poker going forward on what to expect. I'm not going to get spooked and drop a company stock because the CEO didn't give me guidance in a period of uncertainty. They all did that in COVID, and you drop it because you have a different expectation of forward earnings and a different amount of money you want to pay for each dollar of those earnings. But I can appreciate what you're kind of saying here, where you're finding or looking for some optimism in a period of volatility. I would ask you though, man, isn't the fact that we're up at 5,400 versus the 48 and change price that we were at not long ago, don't you think some of that optimism is in the 400, 500 points that we've just added to the S&P 500, the 10% rally that you saw like in a stealth way in the last couple of days?
Yeah, I mean, I feel like the market rebounded back because we weren't in a liquidation correlation 1 environment anymore. It's interesting how quickly this market's changed in the span of a week, right? You and I spoke on Tuesday, right? Last week we flipped.
Yep.
Yeah. So last Tuesday we were saying how we were just like looking for some sort of sign, some signal, a flare in the night sky to let us know that there's an off ramp potentially. And of course, the next day we get the 90-day pause. The effective tariff rate itself is still relatively high, 27% now down to 24. Some measurements have it from going from 23 to 25. Either way, it's not materially changed, so that damage is still coming down the pipeline. But at least it signaled that there wasn't this, ideological bent on just plowing through it all. There was some willingness to readjust and re-examine after what was a very chaotic rollout with that utterly ridiculous formula and chart that Trump carried out on the Rose Gardens lawn. I suppose that's the good news, right? I feel like we're now back in the mindset of the tariffs are here, they're coming, but is it really going to be the worst case scenario? Because if it's going to be the worst case scenario, Trump wouldn't be negotiating with himself in public right now, with China, for example. That, that makes her really difficult. Like you kind of got to say, like, all right, this is an off ramp. The plane's trying to land.
He is negotiating with himself. That is so true.
Like we haven't heard anything from China except they're like, yeah, Boeing, you're not allowed to, we're not going to buy your planes anymore. And Trump's like, all right, give me a call. And they're like, okay, we're going to ban rare export minerals. He's like, I'm telling you guys, just got to give me a call. We're willing to roll it all back. It's kind of nuts, man.
We've made an exception to all the tariffs. We've made an exception to all the tariffs. We made exceptions to smartphones and computers. He's like, they haven't done anything but give us more pressure. We're just rolling shit back. He's the only one making comments. Oh, that's such a funny way to frame it.
I mean, like in response to us rolling back the tariffs on electronics, they banned more stuff coming to us that we need
restricted
to reshore
rare earth minerals.
Man, how many more days of this do we have?
That's after this, you got a whole nother third term to look forward to.
Dope.
Let me ask you this question. So, one way or another, let's imagine the third term it becomes a real thing, which I think would just be the final light to match whatever this 250-year experiment was. It's going to light it on fire. Let's imagine that becomes a reality. Who wins? Obama versus Trump in a battle of third terms.
Sorry, my brain's frying right now. That's like some resistance level fantasy.
That's the WWE. That's the WWE of politics, bro. Obama gets to come back and avenge the birtherism from Trump. Trump and his MAGA base are defending,
You don't get it, Vic.
Whatever.
You guys are going to give us a second term of Joe Biden. That's what this is going to come to. To be Biden-Trump again. Watch.
Can you imagine that
joking?
debate? Imagine that debate in 2028. Oh my God. Mr. Biden, your response?
Listen, I know Bannon was saying this weekend there's like 4 or 5 ways we're trying to get there. When you get to January 2029, he's going to be the president again. There's nothing in the Constitution allows it. Then again, the Constitution is just a piece of paper, and it only has value if we, the people, all agree it has value. And I would argue that several things going on recently suggest that the limits of where the executive branch unitary authority are being drawn are being tested and stressed right now. So who cares if there's a 22nd Amendment?
You didn't answer the question. Who wins?
Oh, the meteor. Please, fuck. Just meteor. Sweet. Is that asteroid still on track to hit the planet?
You're very clever. You're very clever at getting out of questions that you don't want to live like Trump on the internet forever.
Trump
oh shit. That's why you didn't want to say it.
No, that's just I will not entertain a world that should not exist. The Constitution binds presidents to 2 terms.
That's why I said if it happens,
there's no world in which Obama or Trump should even be part of the conversation for the next presidential election. And people who are entertaining that conversation, it's a dereliction of their loyalty to the Constitution of the United States of America.
Chill out, bro. Stop coming on here trying to act like some Boy Scout. You're the one who even brought it up to me in the first place on a text. Were you in the Boy Scouts, by the way?
No. What?
Why are you saying it like that? I was in the Boy Scouts. I think if anyone's watching right now, and we had a poll on the YouTube channel, we said which one of these two was in the Boy Scouts. Who do you think? Who do you think the audience thinks was in the Boy Scouts?
The guy traumatized by being in the Boy Scouts. Me.
I think the audience would probably think that you were in the Boy Scouts and I was out hot wiring cars as a youth. But the reality is the exact opposite.
Is that an anti-Italian slur?
You were out breaking bus windows and shit like this, and I was making Pinewood Derby cars.
That's me in northern Westchester, breaking bus windows. We didn't have cell service, Vic, so what else was there to do? Tipping cows and breaking bus windows. Dummy.
All right, talk to me about Vol, man. Vol's come in. It's getting pumped up a little bit in extended hours, but we're not really doing much. We're staying here, hanging around 30. It's a weird world when you can say you feel like volatility is contracting, and you look at the VIX and you're still at 30, and you're in complete backwardation still. What a weird world where you can have contraction and feel better about the world. You can feel like your distribution's getting smaller, and you're at 30 VIX with heavy backwardation, man. Your thoughts on vol real quick.
I hate when the VIX is in backwardation, Victor.
Why?
I like it because I like trading easy. I like when it's in contango and I can just buy out of the money calls and like sit back and like just be all smug and shit. Like that's the nice kind of trading.
You can come in every day and say, "Hey guys, look at my picks from yesterday. Told you so," and then you just keep going. And you feel like a genius.
When the VIX is in contango, it's being like a weatherman in San Diego, like, "Hey, it's gonna be 74 and sunny. Back to you." And I like that. I enjoy that. No, it's not. I'm not saying that it's not fun to trade and it's not exhilarating. Like the past 2 weeks have been some of the most exciting markets in our lives. Mm-hmm. But also it leaves me questioning, like from a momentum setup right now, there's not really a lot of good momentum. And if I was looking to, and one thing that we see out of like the April bottom or the August bottom last year is that volatility goes back into contango fairly quickly as the VIX, as the volatility compression occurs. And so you could say, yeah, we just had a big sell-off, but like things are going to be okay. And right now the market's saying like, yeah, are they? So nice rebound that we got here, folks. But as long as the term structure is in backwardation, you kind of got to look at it with a little bit of a side eye here. I'd like to see 5,500 cleared on ES. If you clear 5,500 on ES, you're back above the zone where we bottomed out prior in late March, before Liberation Day, of course, when the zone cracks. You also then see us back above the 1 month moving average. And then you have about 250 points of room in the sky to try to make a run at the 200 day or so. And then getting back to the swing highs that you had right before Liberation Day itself. So if you could take it just level by level, right? As we talked about on Let Me Explain this morning, and then when I was on with Overtime, and then with Gus and Errol earlier, risk to reward, you're 75 points away from 5,500 when the market was 54.25 versus 500 points in the low. Where's the risk to reward right now in this market? If you're not in anything and the momentum's still negative, you could take a swing at the downside with a very small, out 75 ES points. Whereas if you're right, you can make a drive for the lows and have a good risk to reward on the trade.
Sometimes I like to look at markets through how can you make the market a loser? Here's what I mean by this. So you're at 5,000 and there's really, really high vol. What are people doing at that point? There might be some people panicking that didn't have the right risk on, that need to buy portfolio insurance at sky high prices, right? They got to buy the umbrella when it's raining. That's possible. So maybe people are buying downside vol. What's more likely at 5,000 and below is probably in a buy the dip mentality that I don't think has been beaten out of people. I think what's more likely is you're jacking vol because the demand for taking risk-defined bets to the upside goes up. So maybe you don't want to throw in a ton of money on stock. you'd rather have less capital and sort of use less risk capital, risk defined, to take your upside bets. But you pay through the nose in vol. So on one end, you've got a bunch of people who bought some downside portfolio assurance in 40, 50, 60 VIX. And you also have a bunch of people that bought upside at 40, 50, 60 VIX. And so the most interesting thing to me is market down small or market up big, VIX down. And then what happens is you basically kill everybody. So all that premium that was bought, it just decays. It's not a winner for the downside. It's not a winner for the upside. And you just get this either slightly trending market in one direction or the other, but not enough to pay on all that volatility that was bought, or you get a completely directionless market. We just decay out all that volatility until people just decide to puke it. And so I don't know that that's any real a high probability of that. Okay, because I said it must be true. But I do sometimes look at the world through like who's buying vol, who's selling vol, and what could that potentially mean? Who's holding the vol, who's not, and what could that potentially mean for the next couple of weeks? Do you look at the world through that lens? And if so, if not, what do you think about it? Do you think it's constructive?
Yeah, no, I do. I do think it's instructive, right? You know, when you enter into a world where you were last week, who's tapping out at that point? It's not mom and pop retail investors. They're not the ones who are on leveraged positions that are getting blown up. Those are the big pod shops, the hedge funds, the guys out there doing this on tilt, 100 times leverage on the basis trade. So when you're down there, I mean, that's why they say for retail traders, when you get this 10% or 20% pullback, it can be for short-term positioning reasons in the market where you get these flushes. And it really ultimately says nothing about the long-term, earnings prospects or growth prospects of the broader economy. So dollar cost average in. And I think, ultimately at the end of the day, that is the tried and true method. If you hold it off on a long enough timeline, your stock position is going to be up if you're DCAing into the broader market. So yeah, the incentives down there, when you see like a 50 VIX and when you see the basis trade blowing out and you think, okay, what happened last August? They were Japanese funds repatriating because of the carry trade, blah, blah, blah. Is that happening again here? Yes. Was it a good time for retail to buy? Yes. Well, the incentives are funds blowing up usually is a good time for retail to get in. And I would just keep an eye for those headlines. And we got that confirmation today that it was a fund blowing up last week. So overshot perhaps thanks to the illiquid conditions in the market, which, by the way, a very illiquid market here. The bid-ask spread as a percent of price for the average stock trade right now is about 23 basis points. The high that we saw in March 2020 was 25 basis points. So you talk about a market where people are being very cautious. It's very light, as it were. Top of the book is pretty shallow.
Let's go to bonds here for just a bit. ZB back at 114 and 23, 30 seconds. I had made the case. I went long bonds last Friday, and I said I was probably going to hold. I thought we could go from when you puke from 122 down to 112, and when I'm playing the game, Chris, and I'm going, I know everyone thinks they know what's happening. Because if you ask just everyday Joe Schmo analysts, they go, I'm going to say with confidence, the market or China's puking our bonds to punish us, or the rest of the world's puking our bonds because we no longer have full faith in credit. And I know that's sort of like when everybody says it with such conviction, I know it's easy to, it's almost sounds stupid to say, I don't know. You're the guy who sounds crazy. But, in the moment, it was, okay, this could be China, Japan. It could be somebody blowing up, and it does feel like and look like somebody's blowing up. It could be something deeper happening in the plumbing of the U.S. financial system, which, again, the blowing up of the basis trade kind of is what that was. And if all that's true, if all that's a little bit true or some of it's not true, maybe this whole, everybody thinking that this is a complete overreaction just to punish Trump and punish the administration into backing up. I don't know if that doesn't really sound right to me. And my point is, after we got to what I thought was probably going to be max pain in bonds, I took a little long side bet and I'm riding it out until I think 115 to 117. When you get back to mid-range, I think it's probably over. And now you figure out what's what. So that's kind of where I'm at. I hate the long bond trade. I don't love it on a midterm basis, but when you blow them out 10 points in a couple of days, I just tend to think whatever the narrative is, that's somebody getting blown up, and that's the market taking their eyeballs out on liquidating them. And that means the price has got to normalize, and then we do something else. We might continue to go lower, and yields might go higher after this, and that whole narrative might prove to be true over the longer term, but in the short term, that is the market taking somebody's eyeballs out. And I'm going to take an upside bet. And who knows? It looks like this time around it paid off. What do you think about bonds, both in the short term and then the structural longer term trade for the U.S. government and our fiscal situation, and how you want to bet on bonds? As you asked Brent Johnson the other day, is the dollar milkshake theory in play, or is that do you need to throw that playbook out?
Yeah, the liquidation obviously is interesting here. I would prefer if we kept this story on the DL, because if it wasn't the bond vigilantes punishing Trump, then Trump may go, oh, so then the bond market wasn't.
Yes. I think that's what he did today.
X-nay on the fund liquidation.
I think that's exact. I think the move today is sort of not a move today, but I think he's getting a bit more confidence the more he sees the bond market settle out.
That's the way this works out, though, right? Like, oh, I took a step back, the market stabilized. Okay, I can give them another punch now. They've right? They're back on their feet. We could start this up again.
Bro, this is fucking wild.
I'm not trying to make a joke there. I mean, I think like if you
I get it. I agree with you.
He's like, okay, everyone's calmed down now. Time to go back in the barrel. I don't mean that in like I'm really not trying to make you laugh. You're making me laugh in this delivery.
Because this
is serious analysis, Victor.
I know, but it's so, at some level, bro, you have to sort of, it's so insane that we are in this situation. You know what I mean? It's almost like you're either going to get pissed off and you're come on here like just furious, or you kind of laugh at the lunacy of the position we find ourselves in, where a president can sort of watch our own treasury market blow up and then go, uh-oh, I might have pressed the wrong button, back up, and then it settles out and he goes, oh, maybe that wasn't me. Press this button again. It's like, oh, Jesus, how do we get here? So what do you think about bonds? Long end and short end.
Yeah, well, I mean, I'm still staying long. I'm still staying long at the long end, because last week, if it was liquidation and, if I want to put faith in our little theory here of the Trump put, then Trump put being in TLT and not in SPY, then certainly have to put some money behind the deal. I've seen others deride it, by the way. People that you and I have talked to in the past say that's an idiotic thing, unquote, to suggest that there's a Trump
what's an
put.
Idiotic thing?
To think that if there is a Trump put in the market, it's in the bond market, right? If there is a Trump put at all, I think is even being challenged here.
Who said it was idiotic? Tom?
I think it was Andy Constan. So that people who are
idiotic.
I think that was his exact wording. Which again, I consider him to be a very smart guy. So
he is.
I say that partially joking. Salute your local trader for getting Trump to stop the tariffs. I'm trying to get us pats on the back, trying to get the people in the chat a pat on the back, Victor. That's all I'm saying here, right? Like they deserve the thanks too. If you were shorting treasury bonds last week, America thanks you. But they've also said to us publicly, if I could push back on this being misguided, they've said they're not looking at stocks. They don't care about stocks. They want lower yields. Trump himself said, I was watching the bond market when the tariffs went into effect. I mean, if it walks like a duck, talks like a duck, tells you it's a duck. I think that there is a line in the sand here, because they understand, forget the refinancing the debt. The refinancing the debt now is going to cost more than it did prior to Liberation Day. So we've new $11 trillion in equity market value, or maybe $8 trillion now only, to refinance the debt at a higher cost. Brilliantly played. So what's the plan now? If we want to bring down yields, what's the plan? This clearly isn't going to do it. And I do think that's a legitimate goal here. If recession is what brings it about, then maybe that's what brings it about. But lower rates helps everyone. That's why people want to keep inflation under control. That's why it's so important to keep inflation under control. You don't get the high rates. So I'm interested to see what next. I do think there is a floor there in bonds. I'm trading around it like it is an ironclad floor until it's broken and the Trump put dies.
Okay. I agree with almost everything you said, except the surety that you have that we are now going to need to refinance at a higher rate. And this is the only reason I say that. If bonds get back to 117, which is effectively where we have been at for months, then we would have been 117 plus or minus 5 points in a really short period of time. And in that short period of time, at the top, Chamath would have said, this plan is working, because he tweeted that out when bond yields went lower, bond prices went higher. And then now everyone's sure that we're refinancing the $7 to $9 trillion worth of debt at a higher borrowing cost. I'm not sure that in 2 weeks we have enough information right now to make the call on either side. And I also tend to agree with Tom on an aspect of this, which is a $50 trillion market is a bit big to try to bully, even if you're sitting in the Oval Office. So I think maybe I want to give this a little bit more time to play out. Right now, I would have never thought I would be long bonds, but the market gave me an opportunity to get long bonds. I think, who knows, it may punish me for that position, but I think it's a decent bet. And I think between 115 and 117, it's probably the place I want to start scaling out. Your long treasuries, which means you think the dollar milkshake could play itself out here. You think as growth slows, you think there's going to be a demand for U.S. treasuries, and you think there's going to be a demand for long-end U.S. debt.
I think the trade right now is for a bounce in treasuries, in part because I think they're going to see further walking back of the tariffs. The tariffs were not a concern for Americans in the last election. Did not register the top 10 concerns for voters. Polling released this week from the same polling firms that were doing it back in the fall, across the board, left, right, Rasmussen, CBS, YouGov, blah, 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 blah. Tariffs have now risen to the top of the list as being the number one concern in the economy, tied with or second to immigration, right? So this has now become a politically toxic stew. And we are, we're not done with midterms yet. Those are still a year plus away. It's a long election cycle, but those are a year plus away, and that's on everyone's mind right now. And if you think about tariffs that are disrupting the small and medium-sized enterprises here in the country, and the tax cuts, which are largely going to be for the big corporations, the politics here really actually do matter for everyone else but for Trump, because Trump's not up for re-election. So I'm of the mindset that you're going to get a walk back. Here's the deal, though. You and I have said before that the number one thing that the United States exports to the world is paper that we print. We control the money supply of. Reshoring the manufacturing is super important. I'm with anyone who thinks that we need to do that. I've tried to do it myself here, in fact, in a business sense. Haven't succeeded at it, but I understand that it's important. I've tried it myself. The reality here, though, is that our number one export is treasuries. We're reducing demand for treasuries moving forward at a time when, if we're going to have all these layoffs in the economy, higher unemployment rate means more jobless claims, more narrow tax base because of these companies shutting down, workers no longer paying income taxes into the system. So it actually hurts the deficit more. So already this year, we have, again, all the talk about what Doge is doing. They're making all these big savings. Fiscal year, we've spent $150 billion more in FY25 than we did in FY24. The total savings that Doge is setting forward is right around that ballpark too. So net, maybe the budget's flat over the past year, but we haven't seen the Doge savings accumulate in any significant capacity thus far. That says we're going to have a wider budget deficit. We're going to have a wider budget deficit at a time when the Fed is telling us they can't can't lower rates yet. And so if we do get a bounce here in treasuries, as much as I love the recession trade in it, best place to hide out during recessions, long into the curve in gold, I can't help but think that bonds may still have a lot of pressure. So the way I'm approaching this, short put spread in ZB, directionally neutral short iron condor in ZN, leaning between the two, net long delta. But I think we just have to harvest the volatility. I think notes and bonds are going to have a lot of chop in them here. There's a lot of contravening narratives in play right now. The tariffs, the recession, the purchase of treasuries, it creates for a roller coaster of a stew.
You mentioned the Fed not being able to, or sort of signaling that they would be. I'm hearing different messages, right? Susan Collins will say one thing: we're ready to support the market. It was very direct message, and I think, very different messages from other people. So I'm curious, when you look at the implied curve right now, or when you look at the implied probabilities of cuts coming for the rest of the year, 1, 2, 3 cuts with a 50-50 probability of a fourth in December. Would you take the over or under on the current implied probabilities of 3.5 cuts for the rest of the year?
Oh, that's a good question, man. That's a really good question. That's a really good question. Oh, man. Over. I got to go with the over. Yeah, I think it's going to be really backloaded. I think the Fed's going to be late to this party. I think they're probably going to come out with one in June and then one in September, and then we may get November and December, or 2 in December. That's a really good. I just have we've seen this. We heard it from Waller as well. Waller's basically publicly campaigning to be the next Fed chair, by the way, with the way that he's been talking. He's not really talking as if he's a regular member or was a regular member. He's talking like he's going to be the guy. And then Besson tells us yesterday they're going to start the interview process in the fall. Kind of all makes sense. But yeah, I would think that Powell is going to slow walk this because there hasn't been the evolution on the hard data yet. The surveys can tell us everything they will in the world. People are feeling the worst that they felt in a long time. Until growth keels over, the Fed does not want to risk stagflation. And unfortunately, right, going through the math here, we take our imports from last year, we separate them by country, and we apply all the new tariff rates, inflation could go up to 5% this year. So the Fed sees that too. They have their little number crunchers, the Marinacles building, doing that math as well. And to them, can they justify cutting rates with 5% inflation potentially coming down the pipeline? They cannot.
Here's a flip side. And I don't necessarily disagree with you, but I think I like when we kind of cover the whole space under the distribution curve. Here's the flip side would be, if you're the Federal Reserve, you're in a little bit of a box here. You have an excuse to cut rates, to create inflation. Are the people going to blame it on you for cutting rates? They're going to blame it on Trump for the tariffs creating inflation. So if you front load your cuts, you're gonna hide whatever potential inflation comes from that under the political umbrella of Donald Trump's tariffs. So the flip side here is that for a strategy to front run or front load cuts versus back load them when it becomes obvious that you're going to have to hold the bag, or you've got inflation from tariffs and now you're starting to cut and make inflation even worse. So my steel man for why you would do the opposite and front load is because you're under a political umbrella that this is Trump's fault. I don't know if that's a good enough reason. I don't know that's how they think. I'm just putting that out there.
Sure. I don't think the Fed operates that way, though. I know we like to think of the Fed as a political animal, but I don't think Powell's sitting here saying, like, I'm going to make Trump's job difficult. I don't think he wants to be Fed chair any longer. He's been in the job for a long time, right? He's had a nice run.
I don't think so either. Who would? Get me the hell out of here before this thing collapses, so it's not on me.
I mean, even talking about his tie the other day, they're like, why do you wear the purple tie? He's like, well, if I wear red or blue, people read into it.
Yeah.
So this guy's out here like stressing over his outfit choices because he knows, like, if I wear a tie that's like, oh, this is on the bluer side of purple, oh, they're gonna call me a woke commie, and if I wear this on the redder side of purple, they're gonna call me a MAGA Maoist. I just love purple ties. Like the guys that wants. The guy wants to just go watch his Dead & Co concerts and like chill. And I heal, hey, who wouldn't?
Let's go a step further. I kind of agree with you. Let's go a step further. What type of Fed chair does Trump and Bessent want to put in place?
The one that has those little marionette strings attached to his hands.
Do you think they want a dove?
I think the Fed chair will be whatever Trump wants him to be as the political moment suits him if we're going into the Erdogan school of economics.
I get it, but you understand why this is an important question. So if you get the dove, you're going to get easy money policy and likely a treasury market that's going to charge a premium. So if your stated goals, you want lower yields, you have to be careful about who you pick and the perception from the marketplace. You pick somebody who's looks like a marionette, they're going to raise your borrowing costs instantly.
Well,
I don't know by how much, but you would.
Who on the right in finance, economic academia, like that world, maybe I'm thinking of the wrong person, right? But who would come up and be the Fed chair who over the past 10 or 15 years has not criticized the Fed in some capacity for too loose of monetary policy? And I think that's the most interesting part of this paradigm here. Most of the people in Trump world who have made their names for themselves in economics and finance have done so in part from saying that the Fed is manipulating markets, is doing this and that, the other thing. And if anything, they would want the Fed to take a step back and put monetary policy on autopilot. So I think there's a really, like, you know who would really help? This is the craziest thing I'm going to say.
Ron Paul. Ron Paul. Ladies and gentlemen, the new chairman of the Fed, Ron Paul.
Janet.
Oh, my God.
Janet Yellen.
Dude, you're
the
out
best
of your
person.
mind.
No,
What
if
are
Trump
you
wants
saying?
lower rates,
That's true.
and he wants to convince them.
Told.
If you want lower rates, and if you want someone who can convince the market that a lower rate regime is coming in, you hire someone who is known for keeping low rates, and you bring Bernanke back. That's what Trump could do.
I can't believe you just said that, bro. And let me say this real quick, because I want to move on to some other. I said it's the craziest thing.
The craziest thing I would say.
I wonder if you feel like she's going on a world tour, right? She's going on a world tour, and I wonder if you think it's appropriate for the former Treasury Secretary to go on a world tour, basically saying what she's saying. And I'm going to explain why. It's not because I'm an apologist, which is what people are going to say. It's because I think she's part of the problem. She set economic booby traps all over this place, okay? She's one of the reasons that the field of the U.S. economy is dry and desolate, in my personal opinion. And I'm not talking about our GDP. I'm talking about the distribution in this country. She was part of the arsonist that got us to this point. And, she played a bunch of games for the last 4 years to set this massive debt bomb and move it along and sort of switch its issuance. And then, so you've got a dry field on the economy and a spark goes off. And she wants everyone to look at the spark and focus on the fire and not ask the question, how did the field get this dry? And my issue is what I think she's doing is less about the public good and more about saving her own ass. I think it's more about trying to ensure that her narrative of her time when she had the levers at the Fed and the levers at the Treasury are protected, that her legacy is protected. And I think that's what she's doing. I see more of her criticism about herself than it is about the common good of the people or creating political pressure. That's my read on it, and I may be wrong. So I'm curious, what is yours?
I think that we have a long history of former officials like Robert Rubin, among others, who stepped in and said things as they've left office. It's unusual that she's been so critical of the prior administration, so in such close proximity to having just left. Right, it's only April of the same year that she was previously serving as Treasury Secretary. That said, though, I think there's a reason why she's speaking up. I wouldn't attribute it to all of potentially looking to rewrite the narrative and save legacy, although I understand why you would feel that way. What makes me here's why I question that, because one of the criticisms of her treasury issuance schedule about leaving the field dry was that she tilted the issuance away from the long end of the curve and focused it more on the front end of the curve. But Bessent just said the same thing yesterday. He told us that if necessary, the Treasury could buy off the run long end bonds, and it could shift issuance up to the front end of the curve. So I get why Yellen is trying to like save her neck, but in the same speech where Bessent was criticizing Yellen for what she had done as her role of Treasury Secretary in terms of the auction schedule, Bessent actually just confirmed he's doing the same exact policy. So I mean, like, it's not good either way. It makes me question whether or not we're actually making the fundamental changes that we need to see in order to get from point A to point B. The short-term pain for long-term gain. I'm seeing short-term pain, but I'm not seeing the off-ramp to the long-term gain yet, because we're just running back a playbook that so many people decried in the past. I'm conflicted here, honestly.
I agree with that part. I did, I think maybe a month or so ago, he gave an interview where he said he was critical of the strategy. He realized the demand for paper at the short end and a few other issues, and realized it was necessary, and he couldn't immediately back out of that strategy. So I sort of hear you, and I don't think it has to be either or, but I do think showing up on 5 or 6 of these national television shows, it's what does she think she's creating political pressure? Because I don't think so. I don't think she's creating political pressure. I don't think people are listening to her within the administration. I think this is about hearts and minds.
You don't think Stephen Miller's like, hey, Mr. Trump, I'm sorry. I got to interrupt you.
You've got to watch this Yellen interview.
Turn on
we
MSNBC
might be doing this
right
all
now.
wrong.
Yeah. Not happening.
Okay, then what do you do with gold here, Chris? 32.57. They tried to kill it. They couldn't kill it. You had 3 plus 100-point days, 120 points, 130 points, 114-point ranges, and they couldn't kill it. We're right back. We're nearing 3,300. Newmont Mining was up 26% last week. I'll pat myself on the back for one thing that worked out. What do you do here with gold, man? The gold-silver ratio is just getting off the charts at 110, 120, something like this. Where's the trade here in metals, in your opinion?
So gold's a really interesting character throughout all this. If the dollar's role in the financial system is not destroyed, but being drawn into question in a very legitimate manner for the first time in many years, then gold certainly has a place. I would think that the best outcome for the dollar, for bonds, for stocks would be weaker gold prices, because it's in a collective sigh of relief that we here on planet Earth all agree that maybe the worst of it's behind us. There's greater earnings potential out in the system than holding a rock, Victor. And yet I find myself very compelled and drawn to it still. Perhaps it's that sheen and luster because it just keeps working. It keeps working, right? And that's, if the fundamental bearings on not necessarily de-dollarization, but in terms of incentives, example, Russia sanctions are rolled back in any capacity, do we think that Russia would keep that money in the Western financial system, in European banks and American banks? No. Is there enough liquidity or trade between Russia and China to substantiate putting all of it into yuan? No. So there needs to be another alternative. They're probably going to put it into hard assets. And if a country like Russia is making that calculation right now, I'm sure many other countries are thinking the same thing too. The Indias of the world, the UAEs of the world. Maybe it's better to have something that's a little bit less controlled on our balance sheet than the US dollar or US stocks or US treasuries or yada, yada. So that seems to be holding up. And given the appearance of not being a reliable counterparty to the rest of the world, which for the life of me, this is why I don't like how Trump approached Canada and Mexico. He's criticizing the trade deal that we have with them, that he signed into law. So it kind of like, you're not going to honor literally, it's not even like the America's agreement that he's tearing up like NAFTA. He didn't sign NAFTA into law. Of course he's going to hate it. But like the The USMCA is your own trade deal. And you're not even going to hold yourself to that. You're just going to tear it up now and say tariff on this, tariff on that. Like that, we're supposed to be the big three here. We're the big three trading partners in North America. And so if the rest of the world sees us treating Canada and Mexico like this, why would we give them any sort of a better deal? We should want the countries on our direct borders to have a good relationship with us. And so if we don't care about torching those, we're certainly not going to give a shit about what relationships we torch 5,000 miles away overseas. And I think that's a counterparty risk now that's in the system that we are asking and trying to address and grapple with in a very real way. And if you don't believe me, go turn on European news, not you, Victor, but the audience. Go look up the conversation in Italy, in France, in Poland, in South Korea, in Japan, in India, in Saudi Arabia about the U.S.'s place in the world right now. And you're going to get you might get a different look than what you see on Twitter, for example, where it's all rah-rah, Doge is doing the Lord's work.
I think that's all fair. One of the issues I have with the framing of this is that other countries are ripping us off. I really hate that framing, and I don't think it matters what side of the aisle you're on. I think it's a disingenuous framing, and there have been a few disingenuous framings, but like for political purposes, which I can understand. I don't want to say I empathize with. I understand where they come from. Like the whole fentanyl thing was to be able to use the emergency tariff, statutes under the law. So by giving that framing, he was able to do what he did, and though it made no sense, and we all knew that wasn't really the driving force behind this. It's certainly a force, particularly for Mexico, but it's not the driving force, in particular for Canada. The idea that we're being ripped off for me is a problem because one, we created this system. We put pressure on all nations to move in certain directions through our direct political pressure and foreign policy, through our indirect policy, through the World Bank and World Health Organization, all these other sort of multinational organizations. We designed this thing. And because I see the world through incentives, Chris, if you were standing outside your house giving away dollars for 50 cents, I would expect over time any dollar you're giving away is going to be gone to your neighbors. And I wouldn't say that your neighbors took advantage of you. I would say you sold yourself out through sort of a bad incentive structure. And maybe in a way that's just your way to sell it to a political base. But I don't appreciate selling this as people ripping us off. We designed the goddamn system to begin with. And so if anything, we sold ourselves out, we ripped ourselves off.
Well, we gave away, we gave into corporatism, right? Like
Yes.
there is we've outsourced the labor for manufacturing to, the outer rim, and our companies in the imperial core take those raw materials and get the outer rim to produce them into finished goods.
Mm-hmm.
And then they import them here and they mark them up at extravagantly high prices for us, shoes, t-shirts, anything. And that's where the profit comes from, right? This is the whole thing that blows my mind. How are we ripping these countries off? We have companies that are getting shoes made for $1 and then reselling them here for 50. They're worth $50.
No, you're not selling for 50, bro. What shoes are you wearing?
Well, right now, these are Target men's, I think, comfy series. What are they called? Comfy boys. the little gentleman collection. I don't know. But we get the profit margin. That's how our companies make money. Like, if anything, we're ripping them off. We don't. But it's our system. Why we have the pole position in the game. We are the number one person on the scoreboard time and again, and we're saying, like, we want to play a different game. Let's play a different game. But to say let's break the game first.
That's my point. Is that if you want to say this is not the right system, this spreads, this concentrates your real wages and your meaningful increase in living standards are going into profit margins, which is going into stock prices, and you 50 to 60%, you don't own any of that benefit. You could say that, and I think people would hear you, and you don't need to make the person who's sitting on the other side of you your enemy, because the truth is, if you're not China in this negotiation, you need everybody else on your side. The game theory of this is the more people we make trade deals with that benefit both sides, that both sides are happy with, that benefit the people, the citizens of those countries, in theory, this is my naive way of looking at the world, then you're creating a bigger trading bloc, which then gives you more negotiating leverage to go and have that bigger discussion with China. So if you make everybody an enemy that was ripping you off for all this time, it's really hard to sit down with somebody and make a deal that both sides are going to feel good about. Chris, I think we're already over time here, but I did want to, if you don't mind, I wanted to quickly throw the Bitcoin thing at you. And maybe if you want to throw in a bonus, any individual stock that you find interesting at this moment in time, or sector, or sort of a theme. I threw out 2 yesterday, I can tell you. They were basically the strategic importance theme. So, any sectors or industries which we feel will be of strategic importance, I think those are the more interesting bets to bet into in periods of volatility, things that will be protected. Like Apple's a good example. If they have money and strategic importance, that's probably where we want to be, because that's where our government money is going to be. And the second was moving dirt around. I think regardless of how this works out, we're going to move more dirt here in America. And I think those themes are interesting looking at. So 2-part question. 1, what do you think about Bitcoin staying relatively calm within the 80 to 90 range, moving towards the midpoint of that? And then 2, do you have any strategic themes or companies that you find interesting on your shopping list as we experience volatility?
So Bitcoin obviously behaves like a high beta NASDAQ stock, but one of the things that it also does is track the global money supply fairly closely. Not in a real contemporaneous sense, right? Not like money supply is up today, Bitcoin's up today, but in a lag sense where like 6 months after the money supply rises, Bitcoin finally gets the news and catches up. And the way that you can measure this at home, we've talked about this formula, I've shared it with you before, Victor, but basically the Fed's balance sheet, less liabilities, the reverse repo facility, and then add in the net assets from the central banks of China, Eurozone, Japan, right? And the more you add, the better picture you're going to get. The funny thing, though, is that because of how those central banks denominate their balance sheets, a weaker U.S. dollar actually translates into a higher M2 money supply globally. And so if we were to follow the line on that chart and advance it in the typical 6 to 9 month window as one would do, it would look like that Bitcoin is on the cusp of another turn to the upside, which we've done all of the hand-wringing and correlation 1 trading, selling everything that wasn't nailed down. When the fear left the market, where did we jump back into? Gold first. Gold ripped once the liquidation fears left the market. If we get risk on, Bitcoin is probably going to rip more than the NASDAQ. I feel pretty good about thinking that. I think Bitcoin, if S&P clears 5,500, we should start thinking about 100,000 plus targets in Bitcoin once again.
Yeah. And then the last question, anything strategic, any themes that you like or individual stocks that you like through this volatility, either to get long or to short?
Yeah, I really like Google and Meta here. I know there's an FTC case against Meta, and I'm certainly a believer that we need to have some Section 203 reform towards social media, and we need to take a heavier antitrust stance towards basically all sectors of the economy right now. You and I are both fans of what Lena Khan was accomplishing in her former position at the FTC. That said, this is a very weak case against Meta. This is an exceptionally weak case against Meta, and it's troublesome how bad they botched this. The argument rests on the idea that if Meta didn't scoop up all of these other platforms on its way to becoming the behemoth that it once was, in this monopolistic sense, consumers would be better off. They wouldn't be harmed, right? But we've also seen that a number of other, as Meta has contended, like how can you prove that if we didn't buy WhatsApp in 2017 or Instagram all those years ago, people would still be using Instagram today? A lot of other companies have started up and failed during that time horizon that never were purchased out by one of the big tech companies. So Instagram may not even exist if we didn't purchase it anymore. Like, how do you retroactively prove that this purchase shouldn't have occurred and it's induced some level of due harm when the competitors at the time all ultimately died out? It's a really tough argument to make. You know, you're going to say like, oh, we could have just been another Pinterest. Okay, cool. It's not exactly a compelling case. I don't know. It feels like the government's case against Meta is weak. I'm really for antitrust reform. You and I have long held that view, but I wouldn't be surprised if this thing, the DOJ loses this case. And so I like Meta on dips.
They will lose. They will lose the case, and even if they win, it will only be, you know, there will be no teeth in any action. The thing about social media, it's population control. And what incentive does a government have to dismantle their ability to maintain control over people in a world where mainstream media, their ability to get out messages is diminished? And not only here, but abroad, right? There's billions and billions of people on this thing, and you have, in some way, a U.S. company who's right in the middle of the ability to pull the levers. We keep doing this. We keep pulling these people in front of DOJ, in front of the Senate, in front of Congress. We keep putting on this political theater that we actually give a shit, that our government actually wants to do something about the power of this company, and it's a farce, man. I'm gonna tell you, if we actually gave a shit about competition, do you think we would have hijacked the only company that has put a dent in Facebook, the only company competing with them? We fucking just swooped up and said, you give this to us or else. Like, we don't care about anyone competing with this company. It is political theater, man.
Corporatism.
And I don't get why people don't wake up to it.
Yeah, we don't have. Yeah, no, we have look. I have said tariffs breed political artifice and corruption. And there is a straight line, in my view, in my worldview, between all of the tech companies making massive donations to Trump's inauguration fund and their companies being at the first of the line for the exemptions. And I'm sorry, we want to reshore manufacturing. We just upended all of that components manufacturing that we rely on off of our shores. All of those small and medium-sized enterprises that operate in that space are going to get whacked. Who lobbies for them? Where's their money? They can't afford to splash around $1 million to the president's campaign contribution fund. They're getting steamrolled here. So will a company like Facebook be okay? Yeah, Meta's going to be fine, because that you just said the vested interest is making sure they're fine. And this creates a barrier to entry. How can the next Meta come about? It's very difficult. It gets more difficult as these interests become more entrenched. And I would point out here, like, monopolies are bad. Our country's founding is rooted in a fight against a monopoly. We don't like the British East India Company having a monopoly on tea, where our merchants had to face steep import tariff levels. So maybe this is going to pluck a uniquely American chord sometime soon.
It's like we cherry pick the shit that we want to focus on, right? Oh, it's the other countries ripping us off. Oh, is it? How about it's Tyson with a stranglehold on meat production in this country? Other countries are ripping us. Is it? Or is it Google that has a stranglehold on search and search results as well as online content? Other countries are ripping us off. Is it? Or is it like food processing that is in the hands of a handful of rich families in this country? It's like we want to turn to the rest of the world and say, you are the problem. And that it may be true that we've set this system up in a way that disproportionately, or it benefits other countries' real economies and it benefits our financial economy, and that system only benefits asset owners and it doesn't benefit the bottom 50-60%. But we built it. What about that other part? What about that other part where only a handful of families own all the key industries? What about that other part where Bill Gates owns 250, 300,000 acres of farmland? Like, why do we cherry pick like a MFer the issues that we choose to address instead of being holistic in the problems in America? And I promise you want better prices, create competition. And people will tell me economies of scale. Well, you know what? You get more jobs if you break down this competition, because those economies of scale find synergies and efficiencies. And, so it's like we have to decide what we want and when we're going to hold both sides accountable. Because this pick the side, I'm for Lena Khan and for monopolies. That means I'm the left side. and I'm for tariff restructuring. I'm on the right side. It's like, what? Both of you guys want the same thing. You want more competition. You want better services at cheaper costs with more jobs. That's a hard problem to solve for, but it's not impossible. It is impossible if everyone divides themselves up into binary points on the line.
We want more competition.
Oh,
Facebook does not want more competition. Apple does not want more competition, right? And that sucks, because when there's no competition, there's no reason to innovate. And I think everyone's a little disappointed with Apple these days. What happened to
Apple? There's reasons to innovate, but not for the right reasons. If you have competition, you're innovating on behalf of the end user. When you have a monopoly and a protected government monopoly, who do you innovate on behalf of? The user?
Shareholders.
No.
Shareholders.
Yeah. And the government powerful institutions, so that you're going to have to donate money to get them elected, and they're going to say, okay, but only in response. But this is what I need from you. You need to silence these people or whatever. And so you're not innovating on behalf of the end consumer. And that's what we have, these gigantic monopolies that started out as free services for the people, that have somehow transformed around them into services for everyone else except the end user. Anyways, Chris Vecchio, it's always a pleasure, my friend. You still got to give me the hookup for where you're getting these $50 sneakers. But if the people want more from you, tell them where they can go on both markets as well as shopping tips.
Thank you for the more gracious ending this time. Starting to get some tweets, Victor, about some jokes that you've made in the past.
I think they call your shoes the School Walker 2.0s, the Air trench coats.
It's a PTA meeting. At CVecUFX on Twitter or X, depending upon what you like to call it. Here on Tasty Live Monday through Friday, 1 p.m. Eastern for Futures Power Hour. And that's Monday through Friday at 1 p.m. Eastern for Futures Power Hour. Monday through Thursday, overtime, 4 to 5 Eastern, right after last call. Of course, we do Let Me Explain with Tom and Tony on Tuesday mornings, 9:40 a.m. Eastern. And going back to next week, I will be on Wednesdays with Victor for The Price of Truth, 6 Eastern.
I realized, the diversify your bonds line from the Chappelle Show?
Diversify your bonds, yes, of course.
Your amortize your fart coins is like the new version of that line. Chris Vecchio, I had a lot of fun in this conversation. Looking forward to speaking with you again, my friend. If you want to follow me on Twitter, it's at Victor Jones. The Owen Jones is 0 because I like to be difficult. Tune in tomorrow for a conversation with Ilya Spivak. Looking forward to seeing you all again. Until then, we'll see you back here tomorrow, same time, same place, same great network, only on Tasty Live. Peace.